We welcome our today's speaker, Sriram sir, to occupy the dais. I request all to please rise for our CA motto song.
Yaesha sukteshu jagrati Yaesha sukteshu jagrati Kamam 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 Usho nirvimanaha nirvimanaha Tadev shukram brahma Tasmin lokaha sarve tadunatyati kashchanatyati kashchan etadvaita 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 etadvaita.
Please be seated. Before video will be played.
Arthashastram, Dharmashastram cha, meaning economic principles, arth, and ethical considerations, dharma, which are central to the work of accountants. The entire world is deliberating about impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the work, where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GLOPAC, proudly presents before the world World Forum of Accountants 2025. Where accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession, where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhumi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025, at the magnificent Yashobhumi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhumi, New Delhi. For more details, visit wofa.icai.org.
It's my pleasure to introduce CA V Sriram sir. Is a renowned expert in accounting standard to today's session on SC 210, agreeing to the terms of audit engagement. He is a director in audit and assurance in one of the leading firm. He has experience in leading Indian listed companies, manufacturing companies, integrated and complex SSC audit, and a complex public company accounting board framework. He has experience in short-term secondment with PwC London to lead us to our speaker.
Yeah, good evening all. As a starter, I just want to understand, is there anyone whom I have met before or who is not able to recollect me in any of the earlier conversations, etc.? I don't think so I have seen anyone. So the topic here is all auditing standards. So the first topic is the engagement letter, and it is followed by the resignation of auditors, again a very controversial topic. The last being the SA 315, which is on risk assessment. So with respect to risk assessment, my co-facilitator Mathangi will be presenting it. But among other things, if you see the regulatory structure, the framework, etc., all these topics from a theory and content perspective, it is only 20-30 minutes from our end. What we would want to really engage with you is understand your questions and make it more interactive if you have any questions, so that you can take it forward. If there are any questions, I can answer it now. If there are some questions which I need some research, etc., definitely by next session I can get back to you. Any specific pointers any one of you have before even we start the session on SA 315 and on resignation of auditors before me jumping into it? So I'll take silence as no questions. So I'll start with a case study. So basically what I've tried to do here is bringing in some relevant recent circulars of NFRA, some recent Companies Act amendments, any changes from a global setup perspective, etc. Maybe I'll just touch base on those for the first 5 minutes. I think then the auditing standard, the principles what we discuss would be very easy. First is on ISA 600. There's a standard called ISA 600 from a global scenario perspective, and there's an auditing standard in India called SA 600. Among other things, there's one fundamental difference in the standard. So basically, the Indian auditor or the statutory auditor, whenever he's issuing an audit report or an audit opinion for a group consolidated financial statements, will be allowed to carve out the comparent auditor's opinion from his audit opinion paragraph. It can be either comparent audit or it can be other auditor. From ISA 600 perspective, that is from a global perspective, this is not the case. There's far more responsibilities for the principal auditor. When we say principal auditor, he is the auditor who is going to sign the group accounts, say in UK or US or be it India, for example. So the person who signs the group consol accounts is called as a group auditor. Then you have the other auditor or the comparent auditor. That's what the standard says. Again, there's one recent NFRA circular which has a bearing to the topics which we are going to discuss now. One is on the resignation of auditors, of course. The other one is on the engagement letters. So that's one. Two, with respect to the implementation guide. So again, from a resignation of auditors perspective, any thoughts as to why the implementation guide first came into first picture? Any fundamental thoughts there from any one of you? Why did the CA Institute need to release a implementation guide on resignation of auditors? Already there is something that is there in the Companies Act. Why an implementation guide was needed in 2019-2020 timeframe? Any thoughts from anyone? Again, I'll cover that. So basically there were a lot of midterm resignations by some of the auditors. Say for example, maybe I'll take a case study. I'm not going to name any of the companies here. There's a company which is a housing finance company. So the group auditor is fundamentally relying on the work of the comparent auditor. As an example, say the holding company is in Chennai and there are 250 subsidiaries across India. Subsidiaries or branches, the case may be, across India. Out of the 250 subsidiaries, there were 38, 39 separate individual audit firms who were auditing those subsidiaries. The consolidated auditor has been signing on the consolidated audit opinion. What was observed specifically by NFRA in this setup was, so basically the branch auditor, as I told, the ISA 600 and SA 600 background. From an India perspective, when the stat auditor signs on the consolidated audit report, he will be able to rely on the work of the component auditor. So what has happened in this case specifically? NFRA picked 5 specific cases of the branch audits, and what was observed specifically is those branch auditors, even though they are issuing audit reports saying independent branch auditors report addressing to shareholders, they have not even been appointed by shareholders. So how did this really come into picture? When NFRA took samples, etc., because when NFRA reviews, they will not review all the branch audits. They have taken sample of 5-6 statutory audits. And what was basically noted by them is there's not even a valid engagement letter first. When it comes to, so that's why I'm coming back to the topic. So basically it's SA 210. You should understand as to what all is happening from a global scenario and from an Indian scenario, and how that links back to the topic what we are discussing. So basically, the fundamental thing of an engagement letter getting agreed by the auditor with those charged with governance itself was missing on those 5 different audits which NFRA reviewed. Such a straight non-compliance as per the standards on auditing. And again, of course, all the professional misconduct etc. would continue. That is something we'll let's not get into the. So basically, SA 210, it deals with the auditor's responsibility in terms of agreeing the audit engagement with management or those charged with governance. Generally in a company where you have board, the executive directors, etc., they might be the people. In other companies where there's no audit committees, etc., it can be with the CFOs, etc. Let's not get into it, it's again an easy topic there. But what is the most important objective here is, I think it's very important, maybe I'll use some 3-4 jargons from the auditing standards, I'll again connect it. There's something called subject matter, something called criteria. I think these 2 are very, very important phrases in auditing standards. Say for example, say if you compare a particular set of, even if you take CA mark sheets, say if someone corrects the answer sheets, they'll have to have a appropriate answer sheet, right, with which they compare. That is called as criteria. There's a criteria, so which is nothing but the applicable financial reporting framework from an auditing standard perspective here. That is criteria. Then a subject matter. The subject matter is nothing but the financial statements. So such financial statements is nothing but as defined as per the Companies Act. So Companies Act says balance sheet, profit and loss, then notes, and again notes come from Schedule 3 again coming out of the Companies Act. So basically the financial statements applying with the roles and responsibilities that is there from, that is required from the management, who are supposed to prepare the financial statements and supposed to have the relevant internal controls that are relevant for the purpose of preparation of the financial statements. So fundamentally, one is criteria, one is subject matter. Always this is getting addressed. Why this is important is there's something called general purpose financial statements, something called special purpose financial statement. Each and every user will have different kinds of a need. We will just explain these things because once we get into the standard, it's very straightforward then. When I say general purpose financial statement, there's some specific set of accounting standards or Ind AS, etc. For example, for a listed company, they have to follow Ind AS. As per again Companies Act has a specific rule for it which notifies that we'll have to follow it. Similarly, if it is not an Ind AS, it can be ICAI nominated standards. Those AS29, AS1 to AS29. So those could be the ones. Fundamentally, there has to be some framework of standards which will have to be complied by the management for the preparation of financial statements. So criteria and subject matter. So that is what it says. So it says very clearly. So the objective of the engagement letter is to establish whether the preconditions of an audit are present. So what is the precondition? The use by management of an acceptable financial reporting framework. In a listed company, it will be Ind AS. For another company, it can be AS, etc. Let's not get into those, but simply speaking, the framework is nothing but a general purpose financial statements. There can also be some specific or special purpose financial statements. When I take an example of special purpose financial statements, it can be something like a banker asking a specific only balance sheet P&L to comply with this debt equity ratio or any debt covenants, etc. It is not going to meet the intention or the needs of all the users. When we say general purpose financial statements, there is consistency across all companies be assessed under the same framework, the criteria. That is general purpose financial general purpose financial reporting framework. And there is also a premise. So the word premise is nothing but what are the things which management will have to definitely comply with. Subject matter, criteria, premise. These are the only three jargons. First, in order to establish whether the preconditions of an audit are present, first, as I told, we have to see whether the financial reporting framework is acceptable first. For a listed company, we will not be able to use the normal accounting standards, etc. because there is a prescription specifically. So clearly agreeing with the management that their responsibility is so and so. It is, in effect, it's just 2 points. One, the preparation of the financial statements is of course the responsibility of the management. 2, for such preparation of the financial statements, the relevant internal controls, the management will have to devise, the management will have to operate, the management will have to ensure those financial controls are really supporting so that the financial statements are not materially getting misstated and it is giving a true and fair. From their perspective also, from an assertion perspective. Management also has another responsibility to provide the auditor with access to all information. When I say access to all information, it can be their ERP, it can be their vouchers, it can be their agreements, it can be anything and everything. Then additional information, as after going through the agreement, etc., we may still ask sometimes some questions in terms of what is the relevance of this agreement, etc. So it can be any questions fundamentally for us to get sufficient and appropriate audit evidence, followed by unrestricted access to persons within the entity from whom the auditor determines it necessary to obtain audit evidence. There are some scenarios in auditing standards where it speaks about don't have necessary inquiries, discussions only with the CFO, etc. Sometimes you should also go back to one level down. For example, the person, say for example an automotive client, generally warranty could be a very, very important area. So unless we go and speak to the person who is handling warranty claims, we will never know what's really happening there for us to obtain sufficient appropriate audit evidence. So in terms of unrestricted access to persons within the entity, what we decide is appropriate, that is the auditor decides is appropriate, all these are management responsibility first. One, the standard also says if something is coming very clearly in the law and regulation, you need not actually agree any of these points in a standard engagement letter. But the standard also says in the application material, it is always beneficial for us to agree all these terms in the engagement letter. I'll just cover what are so these are broader principles. What exactly will have to come in the engagement letter, I'll come to this last 2 points towards the end. So what gets into an engagement letter? So one is the objective and scope. For example, if it is a statutory audit saying so-and-so person is getting appointed for so-and-so period, generally from the conclusion of this AGM to conclusion of this AGM, etc. and clearly telling why we are getting appointed by the AGM or through shareholders, whatever it is. That is the objective and scope. Then comes the responsibilities of auditors and responsibilities of management. So responsibilities of auditor is equally important, but I'll start with responsibilities of management first, then we will get into responsibilities of auditor. From responsibilities of management perspective, for example, I'll just give you one example. Say there's a very small company and they have outsourced all their accounting, financial statement preparation, TB monitoring, say to some others, consultant, etc. Whom do you think is responsible for the financial statement? Is the management or the third party? Third party. That's very, very key. So net it says, whatever you do, management is responsible for anything and everything from a financial statement preparation perspective and internal controls. Again, the broader aspects within that would be assessing whether the company would continue as a going concern. Are there any necessary accounting judgments, estimates, for example on provision for depreciation, anything for that matter, all comes under the gamut of the management. So all these things would be ideally coming under the responsibilities of management. And one important point, definitely some of us would have encountered this. Why should the auditor even get a representation letter? Having said that, because he has already audited all the numbers, etc., he's got sufficient appropriate audit evidence. Why the need for representation letter? Either as an auditee we would have asked, or either as an auditor we would have received this question from the client. It is there in the standard. It is also one of the important points. Among other things, whilst a representation letter will cover about the the normal management responsibilities that they have given all supporting, etc. to us, it also speaks about subsequent events. If there is any material adjusting subsequent event which happens after the balance sheet date, before the approval of the financial statements, unless someone represents, we will not know. We might be missing on a material subsequent event. So written management representations is a mandatory step as per SA 580, needs to be agreed in the engagement letter that the management will be providing that to the auditors. It's also very key. Then comes to the responsibilities of the auditor. So basically we'll have to, I would bracket into two halves. One, agreeing with the management that our role is to provide a true and fair opinion on the financial statements which we are auditing, of course. But the most important thing is the form and content of the audit report. So when I say form and content, unless we audit, we will never be able to say whether we have obtained sufficient appropriate audit evidence. If we have not obtained, naturally the conclusion or whether it's a qualification or a modification, disclaimer, anything for that matter would come into picture. So it will be, among other things, the engagement letter should very clearly say, yes, we are doing audit as per the auditing standards, etc. But net, even if there's any fraud, error, etc. that happens, it is still the responsibility of the management, not the responsibility of the auditor. This is also something that need to be there in the audit report. Then the other point is, while the preparation of the financial statements is their responsibility, that is management's responsibility, from an opinion perspective and from a form and content perspective. Opinion that if everything goes well, true and fair, I'm just using no loose words to understand, to make it very simple. The other thing is the form and content would vary based on our audit findings, conclusions, etc. Any doubts still here? Or any clarifications? So, I think the most important takeaway is written representations, that is the management representation letter, is a mandatory audit evidence for the auditor, without which the auditor will never be able to close the audit file. It's a mandatory step both for auditor and auditee. I think that's the key takeaway, you should take it from here. So these are some of the, not some of the, I think across all the points are getting covered here. What is the scope of the audit? They say, why the audit is getting done from a stat audit perspective, from when to when we are appointed, all those things will get covered in the first point. Then the form of any communication of the results of audit engagement. Because, for example, if you take listed companies, there's something called key audit matters. From a key audit matters perspective, first there has to be a discussion with the audit committee. So the matters that get reported in the audit report as key audit matters should be the points that have been earlier discussed with the audit committee. Those are all matters discussed with the audit committee or those charged with governance. We apply some filter and say these are the areas which had significant audit attention, accordingly we report. So basically there could be reporting obligations also even before we issue a formal audit report. That is SA 260, those charged with governance standards may cover it. So then the requirement for the auditor to communicate comes. It's a listed company, yes, it has to be that's there, and a specific agreement in the engagement letter. Fourth point is very important. I think this is something I've seen from my CA days as to why this is there, etc. The fact that because of the inherent limitation of an audit, because there are inherent limitations, there is an unavoidable risk that some of the material misstatements may not even be detected by us, even though the audit is properly planned and performed in accordance with the SAS. Because basically there is something called sampling risk, definitely. So even though how much ever audit we do in some of the expenses area, yes, we would have done all walkthroughs, inquiries to understand the business process. Scott's, when I say Scott, it's some summary class, significant class of transactions. What may still happen is because of sampling risk, something may go wrong. Maybe just one invoice had an error. One invoice may have some fraudulent activity or suspicion, something like that. We could have still missed in sampling risk. This is an important paragraph that has to be there in the engagement letter. And any arrangements regarding the planning and performance of the audit. And generally what happens is we kind of cover with those charged with governance. For example, for a very, very material listed company, where we see April 8th, they issue their results. March 31 is the closure. April 8th, they are giving the results. Auditors also signing on that day. Unless a significant planning is happening on those kind of engagements, starting from September, October, November, December time frame, definitely that is not possible. So this is to cover that piece. So it can be for any audit, but from a listed company it is very, very important, because what you will have is only 7 days after the book closure of March 31 and press release happens. So that's also very important. The expectation that management will provide written representations, it's a mandatory step, it has to be there. And the agreement of the management to make available the draft financial statements, again it's a precondition. Unless they prepare, unless they have the necessary controls, etc., we will never be able to start our work. So that is a precondition that has to be there in the engagement letter. Then, then the subsequent events. So the agreement of management to inform us if there anything that happens after the balance sheet date, before the auditor's report date. Again, that is very, very important from engagement letter. Unless they tell, we will be missing out on a significant disclosure or even a significant accounting matter also. That could be there. The basis on which fees are computed in the billing arrangements. I have seen two different types here. Some engagements, maybe I'll tell some practical difficulty. What could also happen is, in some of the cases, the engagement fees shouldn't have been agreed. And what we may do is, before even starting the audit, at the time of commencement of the audit, fees is not agreed. Still we'll commence the audit. We'll keep discussing with the management, auditor will be happy, etc. But there is no binding legal agreement. Say what happens by the time you agree the fee, you unearth the fraud, and 143.12 reporting comes into picture. On what grounds we'll be able to report? We don't even have a binding engagement agreement with us. In those kind of a scenario, what is always advisable is have an engagement letter, agree all the terms and conditions. Maybe there can be a service scope letter where we can say fee alone will be agreed separately. That is okay. But the master engagement agreement with all the terms, at least the broader terms here, it's always better to get it signed before even we commence the audit or in very, very initial stages. Because even engagement agreement is forming part of the planning activities. It can never go to your execution or conclusion. Then the last point, I'll anyway cover in the resignation thing. So basically, there was a notification a circular by SEBI which said from a resignation of auditors perspective, again I'll give some background etc. about NFRA there. What happened there is, if an auditor signs the first 3 quarters, it is mandatory for him to sign the 4th quarter also. Now it is a mandate coming from this circular, SEBI circular. So again this has to be agreed with the management. So where will you agree? It's engagement agreement. And these are all additional things. If required, we can add it here. So any experts, etc. For example, management may actually bring a point. For example, they may have an actuary for their all gratuity evaluation, etc. Say if it is an oil and gas company, they might have a reserves specialist who will have to audit the reserves, and because at the end of the oil and gas, reserves is the most important matter there. Someone has to value it, someone has to do all the necessary stuff. So those aspects can also be brought in by the management, and we may also agree that. And arrangements concerning the involvement of internal auditors. Whilst we may not directly use the internal audit work from our nature, timing, extent perspective, but still one may always evaluate the points that is coming from an internal audit. So in that way, it is needed from internal audit's point also in terms of what are the arrangements they have and whether they will be giving all the finalized or draft internal audit reports till the time the stat audit is closed. And any restriction of the auditor's liability when such possibility exists. Again, I can think of some example where it happens on a US SEC audits and all. What happens is, for example, say the principal auditors in UK or US and he or she is offshoring some of the work to India because of some large corporates being in India also. But if the holdco is listed in US, they will never be able to say that this competent auditor is handling it. So accordingly, the liability is restricted. So always liability is not restricted for the the main audit firm that is happening there in US. So there could also be a point in terms of whether the liability restriction from an engagement letter perspective. The last one is any obligations to provide audit working papers to other parties. So again, this is very critical. This is one of the recent NFRA amendments. I don't think so we have any guidance already from Institute. Maybe apologies if I missed it. Maybe I'll just tell what happened on this and I'm not connected to that. So the SA 210 allows obligation to provide auditing work papers to other parties. Anyone can think of any challenges if we share work papers to another auditor? Any quick reflection? Of anything that can go immediately wrong if we share work papers to someone else? I have a client. I am auditing them. I have post confidentiality, so it can be code of ethics. That's the most important point. We can never share any of the work papers to unless the client or unless there is a no legal obligation, etc. So confidentiality is the most important thing. But there's an interesting circular that came in October 2024, very recently. Among other things, so they have NFRA has gone through multiple reviews, etc. So any one of you have read any NFRA reports recently in the last 2-3 years, at least broad level? Okay, maybe then I'll cover that. So basically, what happened is that lot of midterm resignations of auditors that was happening in 2018, 2019, etc. In the same time, NFRA also started probing the practices followed by the auditors, whether they are compliant with the auditing standards, SQCs, professional standards, etc. That was happening. There are various reports for various firms, various audits, etc. Some few examples which they took are again the ISA 600 and SA 600. From an India perspective, so the group auditor or the console auditor, assuming I am the auditor for the console, I will be able to rely on the opinion given by the branch auditor or the component auditor. Holdco, A, B, C, D subsidiaries, A, B are not audited by me, someone else is auditing. He or she is giving an audit report to me. I will be able to take that audit report. If it is clean, I will also say it's clean to that extent. But I will clearly carve out it is audited by them. I have not done any procedure. This specific carve out is there in SA 600. Now, what the NFRA has told is maybe I'll just tell what all he has covered in the circular. He didn't restrict to only SA 600. So NFRA is telling there's one word they have used, some fallacious reading or some incorrect reading of the standards. He said don't read only SA 600, that relevant paragraph. You see, in the context of the auditing standards, you started with SA 200. SA 200 says the auditor, so the auditor will have to have sufficient appropriate audit evidence for the financial statement which he is signing. There is never a distinction of the group accounts and the stat accounts, the component accounts. There is no distinction. It's only in SA 600 there is a specific paragraph which speaks about that as long as there is an auditor, unless we have any reason to believe, etc., we need not actually go and check the component audit work papers. So what the NFRA has told, among all other things, is it's very important in terms of it says for the group auditor to actually issue a true and fair opinion, assuming everything is okay, true and fair opinion, unless he or she is able to review the component audit work papers to an extent that is needed, to an extent that is again professional judgment. It need not be all work papers, like at least some significant risk areas, etc. That could be there. That is different. Unless he or she have some supervision of the work of the component, he will never be able to report from a SA 600 perspective. That's what he was saying. Basically, all the midterm resignations, all the scandals that have happened in 2019, 2018, 2020, etc., were all because of this, because the group auditor is not identifying any red flag at the time of issuing the group opinion, but still the group is failing because there are some challenges at the branch level or at the subsidiary level. So how it links back to this standard is, the standard already allows any obligations to provide audit working papers to other parties. So again, the Companies Act says, in fact, Companies Act defines the financial statement. It comes under section 129. And it very clearly says, financial statement, whatever is getting signed, should have true and fair. So it indirectly includes consol also. Unless the person who is signing the group accounts is obtaining sufficient appropriate audit evidence, how he or she will be able to sign the group accounts. So in net, it's a statutory obligation for the group auditor, if need be, to obtain working papers from the component. That's the NFRA conclusion on a recent circular. How this will come into play, etc., that's something we have to wait and watch. But it's a very, very recent circular. But the linkage back to us, it says any obligation to provide audit working papers is already there in SA 210. Maybe this is something, if we have to share to the primary team, or to our principal auditor, we will have to have this obligation clearly agreed with our client. As she told, the confidentiality matter, we'll never be able to give our clients' our working papers to someone who's not auditing this client, who's not auditing this company. So that's the key background there. Just thought I'll just cover that point as to how this point is getting linked to that. Any questions still here? Anything specific?
One second. So, only the financial statement on the audit working papers the group auditor can ask. Good evening, sir. My question is it only the financial statements of the components or even the audit working papers?
Audit working papers.
Okay.
So that's what I'm saying. So from audit working papers, because financial statements is at least supposed to be available in the public domain. They'll be there in the public domain. Go to MCA, we'll be able to take the financial statements if need be. It speaks about the audit working papers. We have to wait and watch as to how this is going to translate into any further circulars from ICA, etc. But at this point of time, this has already come out. And the circular says this is with immediate effect. So the important thing is again SA 210. If our engagement letter is not appropriate in all the aspects which we are discussing, this will have a problem.
So this is also circulated in October.
Yeah, October 2024 circular.
Good evening. My question is, what if the components had KANs, which is ultimately
If the components had KANs that were obligatory to management to inform the auditor, the group console auditor, and they did not happen for whatever reason, can ultimately the group console auditor be held responsible?
No, as of today from SA 600 perspective, it only says the principal auditor should assess the integrity, objectivity and competence of the standalone auditor or the component auditor.
How
that is there.
Possible?
That's what I'm saying.
Practically speaking, I think that's a huge challenge, isn't it?
So,
Because I rely on the work of the expert.
yeah.
And if there's a key audit matter that emanates from a group, component,
Correct.
how am I expected to?
So again from a SA 701 perspective, it very clearly says there has to be active communication with the subsidiaries, etc. But with a lot many firms getting involved, this miscommunication can be there. So
I see this happening in the banks.
Yeah.
Typically, this is when that happens.
Yes. So specifically, what has happened is, I think in some of the corporate cases, what we have seen from the NFRA auditors, these branches had problems. Those branch auditors have resigned midway. Someone else has come, but not fully into the grip of the entity, etc. Still issuing a clean opinion or late opinion, but console is getting signed. So that's where the disconnect was. So again, this is going to be a space where there's going to be a lot of discussions, points, etc. And again, I think once this changes, I think we'll have a lot of changes or communication with our clients also. Because definitely clients will also have challenges.
It is more on the auditors to share the working papers with the console auditor or the component auditor.
So primarily it's coming from the professional ethics. We can't speak anything about our client to anyone else. The principal auditor has no linkage to me. When I say principal auditor, it's a separate firm, sir. You see it that way. First, X person is Y person. He's in Bombay, I'm in Chennai. I have no clue with him. I have no working relationship with him. I cannot share anything. There's going to be confidentiality matters.
But the same group only, because Then
No, but
I can mention in the engagement letter that in case if it is required by the consult auditor, that I may have to
So
share.
exactly, no, that is what is coming today. NFRA says for the purpose of the group audit opinion, the principal auditor, if need be, can request. But again, there's some
If we mention in the engagement letter, then it can be shared with you.
But again, we have to see as to how ICA is going to respond to this, because currently it is not allowed. Currently, no, I have not seen any cases where I share the working papers of my ex-client to my group company, etc. We generally don't see from an Indian scenario. Anyone have seen that? I don't think so anyone would have seen. We've seen.
No.
From Indian Holdco.
The auditor can go and review the work papers.
Yeah.
Sharing is like they don't share copies.
Yeah.
As a principal auditor, some companies they are allowed to go and review the work papers.
But again, that would need a agreement with the management, right?
Yes.
Unless the management knows this, someone is going to come and review.
Yes. That's
Again, his NFRA interpretation today is this provision is already there. Because SA 200 says the opinion should be for the console also. The console auditor should be comfortable with sufficient appropriate audit evidence at the time of group audit. If this has to be there, naturally this obtaining or seeking audit working papers is already a precondition. That's what he's saying. The way we were interpreting this is a carve out. As long as there's a clean opinion, etc. And it still says, the SA 6 also says, assess the integrity, objectivity, competence. Based on the overall supervision, etc., you can still take a call.
only for the significant risk.
Yeah, significant risk areas, estimates, etc. But it's an evolving area, we'll have to wait and watch, because globally also the ISA 600 is undergoing changes. I think people working on MNCs would have seen this. So what is happening is, generally, maybe I'll just tell something about a group scoping. Assuming there's a huge entity in UK or US, as the case may be, and there are hundreds of subsidiaries across the globe. What generally used to have is, say they used to have a threshold or a materiality. They used to call something as component material. Anything that crosses that threshold will naturally be picked for audit. So those respective components will continue to audit those engagements. Today, the standard ISA 600 allows for risk-based audit. So the principal auditor can still say, even though it is material, the transactions are very, very simple, etc. I can still not even scope that legal entity from an audit perspective. So this is also changing. So from ISA 600 there are changes from a SA 600, from challenges from a SA 600 perspective and this NFRA circular. Definitely there will be a lot of guidance discussions on this topic. But it's a very, very recent topic. Any further questions on this?
Sir, sole proprietor angle.
Same thing.
How much to trim? All this is all not.
But it's mandatory, sir. As I told you, say for example, you miss out on an engagement letter. You don't even have the engagement letter with the client.
We have all these items you have to put out.
No, to the extent it is relevant. For example, if it is not an initial audit, you will not put point number 3. You will not put the point number 3. And again, the CA, there's a specific implementation guide which has a lot of illustrations. We will be able to borrow those illustrations. Among other things, I think the management responsibility is very, very fundamentally key. Because if there's any screw up there, naturally we all will have challenges at a later point of time. If it's a listed company, you will not even be able to report if you find anything on 143 note unless it is agreed in the engagement letter. That's the point that is coming out. So audit of components, maybe I'll not cover too much. But again, for example, if there's a group, for the group audit, the primary team or the group console auditor can have an engagement agreement with the holding company. If the same management, same board of directors or the same CFOs, etc. sit in the subsidiaries board also, generally there can be one common engagement letter. If it is very different, this person is different, that person is different, then there can be chance of 2 different engagement letters. It only speaks about 2 different engagement letters, but the most important thing is, from a group audit, we may not even be, because we might be issuing reports to a group auditor for the purpose of group audit. But still you may have a local statutory audit for the Indian subsidiary, etc. If those kind of things happen, that is, you should have a separate engagement letter with the local management because their group has no responsibility. Again, just a flavor in terms of how things are. Yes, sir.
It is slightly unrelated to what you talked about. From an audit rotation point of view,
Yeah.
just answer this. Are you able to hear me?
Yeah. I'm able to hear rotation, then I was not able to hear it fully.
So there's this company in which there are some present auditors, and they are getting covered under the audit rotation rules, and they are in the second tenure of the audit, the second part of the tenure. Now what's happening is, let's assume it's a situation where the company gets demerged into, let's say, 2 or 3 entities, and those 2 or 3 entities either get covered under audit rotation rules by virtue of the rules which apply, or don't get covered. So the main entity's audit tenure gets over, let's say, in the next 2 to 3 years. Would that same rule apply to the newly formed demerged entities, or would it not apply?
Ideally it should be. Ideally it will apply. Because it was the same group not till that point of time. It just demerged. An accounting transaction cannot really have a flavor or impact on the audit rotation. In substance, it should apply. But maybe we can, I can also check and get back on this point. Because in spirit, you will never be able to comply if the same auditor continues for so many years, etc. And this is for recurring audits. Again, there is some misconception, because with auditors getting appointed for 5-year term, no ratification, etc. We put an engagement letter, say in 2020, it goes till 2024, 2025 as the case may be. This is there. But what gets missed, I think there are some QRB findings also, that's why I'm just stressing on all these things. There's any special terms of the agreement. For example, in year 1, we would have done only the company act audit. There would not be any certificates that were issued. Or tax audit would have been done by some other firm, etc. So what may happen is, say in the second year or third year, we may also have assumed tax audit responsibilities. If that is happening, then naturally the engagement will have to undergo a change because the scope changes. I think we should be mindful of any scope changes, any business related changes, and even the management changes. Because what happens is, see, when the earlier management signs off on a particular engagement letter, say the new management may have some point of view or a disconnect. So if there is any change in senior management, it's always appropriate to reconfirm the engagement letter for the remaining period. So that's very important. See, what happens is when acceptance of change in terms of the audit engagement. After, imagine a position we have started, I think there are there are 3 scenarios here. The first scenario is, you start an audit, it's ongoing, say a company or corporate audit, it's ongoing. So the management wants to change the scope suddenly. What's the answer there? So that's one. Before even starting the engagement, the management is not even agreeing for some specific scope, etc. It can be a management inability to provide some evidence or something like a scope limitation. That also could be there. If we see the first scenario, we should see a reasonable justification first. For example, what may happen is, we are doing a stat audit. Suddenly the management says, I don't even need to prove and fair, I don't need a reasonable assurance. All I need is only a certificate or only testing this particular thing. So the engagement letter will have to undergo a change. But are there any consequential law and regulation issues we should see? For example, they may still appoint some other auditor. Someone else is doing the stat audit. What they need from us is only the certification service, etc., which is allowed by the stat auditor or by any other auditor. Then to that extent, the engagement letter need to be revised. So there's a justification there. And what may happen is, for example, in a case fully audited, towards the end, say there's a receivable, not receivables, let's take loan, because most of the NFRA orders are on loan receivables. We give a loan to a group company, and we're waiting for the group company confirmation. We are doing some procedures. We are saying there are 2 questions, one on arm's length of the interest rates of the loans given, 2 on the recoverability of the loans itself, because the financial situation of the subsidiary may be bleak, maybe weak, etc. So these are 2 points that are there. And towards the closure of the audit, we are not having sufficient appropriate evidence. The management is not able to give necessary evidence, etc. And that point of time, if they say, no, you have completed everything on these 2 procedures, I don't think so, we will be able to provide anything. Ideally, it gets into an adverse, or it can also be a it can also be a disclaimer at that point of time. It all boils down to the stage at which the audit is there. At the inception, maybe it is easy to withdraw from an engagement, but maybe on September 13th there's a clash, or September 25th if there's a clash, it's very difficult unless you have to do a disclaimer, come out, and next year someone can actually pick it up. So it all boils down to what level and not what point of them we were there. And there are situations where when the engagement letter, the management do not even agree for issuing representation letters. They say, at the name of EL, I am not going to give you representation letters, etc. There are cases where the auditors have come out saying, I will not be able to accept this engagement. So how important is agreeing the terms at what point of audit? It's always better agree at the start, because the consequences will be more on our part also. When I say our part, from an auditor part also, if engagement agreement gets signed towards the end. So these are some of the QRB findings. The institute publication runs into some 700 pages. I've just taken some top 7-8 issues. The first issue which they have found out in review of some of the pages, EL not even there prior to commencement of the audit, we have discussed. Again, it's there as a precondition, very clear. Unless management accepts very clearly that this is a framework at which they are going to do, internal controls they have to establish, they have to give the necessary access, records, etc. to the auditor. If this is there, they will never be able to start the audit. So that's the first point. There were situations where EL was not signed by those charged with governance or authorized by the board. In the example which I gave, the first example, the holding company, 250 subsidiaries were there. Out of the 250 subsidiaries, 5 subsidiaries, I don't know engagement letter was there. I told no shareholders appointment was there, because generally shareholder will appoint for a 5-year term, etc. Who was signed the engagement letter there was a senior clerk or etc. There was an engagement letter. Again, if it is not getting signed at an appropriate level, it won't even bind us, it won't even bind them. So that was the point, that was already there in NFRA order. So that's again the same fourth point. EL was, it is not covering all aspects. Engagement was addressed to senior general manager. It can never be. Those charged with governance or the management, CFO, etc. So not including in the EL the reference to the expected form and content of any reports to be issued. This is again very key, because unless we tell them, we obtain or we have to get all the necessary evidences, just sufficient appropriate audit evidence based on our nature, extent and timing of the audit procedures. Our form and content may vary. Unless we tell that, there will be an indirect presumption as if we are going to issue a true and fair opinion. So this has to be there. Based on the findings, my form and content will change. So this is also in one of the engagement letters, wasn't there it seems. The last one, no separate engagement letter for e-filing of tax audits. Again, 5-year term, no ratification, first year appointed, suddenly in 3rd year we have taken tax audit or any certification service. The master engagement agreement doesn't support the new service. That needed a revision. So from a recurring audit perspective also, keep revisiting in terms of the scope of services. So audit engagement letter did not contain terms of assignment and fee. It's up to, we can have 2 letters. Other than fee, there can be a letter. This is a case where fee was not even agreed. So any specific questions on engagement? I think this is what I wanted to cover on engagement letters specifically.
There are additional services provided. An addendum enough or a new addendum? When additional service is provided, is an addendum enough or a new master service engagement?
Addendum is enough. See, sometimes what generally happens in practice is, you may have too many addendums, 3, 4, 5, 6 addendums. What happens is the original crux of the engagement letter might get lost. It's better, if it is 1 or 2 addendums, better to have addendums. If it is more than 2, 3, etc., it's better change the full engagement letter, have these services also added there. Unless it is not a prohibited service.
Instead of signing these letter of engagement, if they say we will not sign but we will give you an email statement confirming all these things from the registered email, is it accepted?
It is allowed as per the institute guidance note. Implementation guide. It says there's an acknowledgement through email, it's okay, or we say, because it's assuming the facts are very clearly there in an email. It is allowed. But generally that practice is not encouraged. It's better to have the engagement letter signed so that there is no dispute at a later point of time.
Only thing is, they say this, when you ask them to sign it, they take as much time as possible, and we have very little time in audit. So, the other way is, we will send you the email to start the audit. Then follow it up becomes very difficult.
Understood. I'll just tell my own case. I have 3, 4 audits which I handle. So I have a checklist. In the month of October, I have to complete the engagement letters. I have to complete my engagement and client continuance. So acceptance is the first year, continuance is for the second year. Within the continuance, there can be 2 things. One, the client is getting continued, a service can get added. So these two I close it by October. So I have a clear sign off from the engagement partner, from the client, so that this is, because from a planning perspective we are very, very clear. Because planning really starts in the month of November. You can, because unless you start it, you will never be able to issue audit reports in the month of June, July, at least for a medium-sized client. Then it all goes to the month of September. It's preferred once the September cycle is over, maybe a month or so, the engagement letters are getting signed for the next year, if there's any change.
The year is required for certification of also.
Yeah.
For each and every certification separately?
Yes. If it is coming from the guidance note, we can say this certificate has to be issued based on the guidance note, etc. Again, the reason is why year is needed, I'll tell you. The first point which I told, criteria, subject matter, premise. Subject matter is certification. Preparation of a certificate, there is no general purpose framework. It can vary based on RBI need, it can vary based on banks need, it can vary based on whatever need it may be. So management responsibility would change to that, not to that extent. Or form content would also change in a certificate. That is also there. So naturally, unless these are agreed in an engagement letter, it can be forming part of the main engagement. Saying for the stat audit, this is my engagement. For certification service, this is what is the management responsibility, the auditor's responsibility. Those point 2 and 3 which we covered is mandatory to be there in the engagement agreement. For certifications also.
Internal audit and concurrent audit.
Concurrent audits, I'm not sure, but internal audits of
banks. Concurrent audits of banks.
Should be, sir. Any audit, unless we, because ideally I said, unless there's a binding from management and the auditor, we'll never be able to discuss on anything. No? See, if there's going to be any dispute on written representations on concurrent audit, I'm just presuming, because I have not done bank audits. Assuming written representation are mandatory in bank audits also, say in concurrent audits also, they have to give a representation letter. Unless there is a binding, if they give it, okay. If they don't give, this is the only thing that can help us.
Because concurrent audits are all where from it, okay? Zonal audit office or RO or...
So it all boils down to whether it is performed under the general purpose financial reporting framework or a specific purpose. There's a specific purpose, etc., then the relevant rules can come into picture. I'm only speaking more from a corporate perspective. You audit from a stat audit of a company because they do a general purpose financial statements. So that's the applicable financial reporting framework. For that, definitely these things are needed. For NPOs or not-for-profit organizations, etc., things may change. Concurrent audits, etc.
But there it's mandatory to take because the peer review that will also be taken upon. So that now the peer review is also mandatory for all the persons who are all handling any type of grant audits also.
Okay.
So in that perspective, because not all the firms will be involved in doing concurrent audits.
Okay. Ideally, I would think it will be mandatory, sir. I have not done bank audits, concurrent audits. My view it should be there. Unless there is a binding on the relevant terms in those conditions, there will never be a binding between management and the company.
But the peer reviewer is asking for it. So
then mandatory. There will be some need. Except the form and content may change. The form and content here, because I am doing a general purpose audit, I am saying there is a sampling risk. So I am saying there is, because it's an audit, there is an inherent limitation, I may not be able to identify fraud or error. It is your responsibility. That relevant term may not even be there in concurrent because there you may have to audit 100% also. Who knows? That's the case, then that change would change. That particular paragraph will change. Yes, sir.
So in respect of NFRA, compelling the consolidated auditor to have a control over the component auditor, they say that it will affect only 1 or 2% of the auditing community. Are they having something in mind that for select companies has to undergo all these things or in general?
Sorry. Again, it's a very recent topic. I'll give my view.
It was reported in Economic Times.
Yeah. So based on my reading also, I think historically the reason that was quoted by the industry experts or whoever represented this issue is, if the principal auditor is going to have, again I am also telling from what I've read, it's not my view, whatever I've read, because we have to wait for the institute to come with guidance. If the principal auditor, say, has the full hold on components, etc., one of the points that may happen is the small firms may lose out those engagements audits. The principal auditor, generally the mid-sized firms, large firms will be able to take overall control of the component because they need the coverage. All the important subsidiaries need to be covered, etc. But this might go out of the ambit of the small firms. That is the general industry view. But from principal auditor view, if he doesn't have this control, he is signing an incorrect opinion. So there's a risk and reward there, which we'll have to match. Because you see, most of the NFRA orders that came in 2018 to 2020, the issue wasn't branch or the subsidiaries, not identified by the console. It's a clean report, no red flags, but it eventually came out. So we have to see what is relevant, whether it's true and fair or the other things. Any questions, sir, before I go to the next item? Okay. So next is resignation or withdrawal from an engagement to perform audit or financial statements. I'm not covering the Companies Act provisions here. That is the removal of the auditors. If someone has to be removed, go to central government, etc. I'm not covering that. Again, more from a NFRA, and what is relevant today is what I'm covering. I'll take one case which I've read, which is very, very important as to why this implementation guide first came. So the rationale is there were frequent abrupt resignations. There were not many resignations where the auditors went midway. For example, say the board meeting was on a Friday. Monday, the auditors resigning by saying preoccupied reasons, health reasons, administrative reasons. Whether that is correct, incorrect, let's not get into it. But what happens to market? What happens to credibility of the financial statement? It's definitely at stake. That's something we all have to agree. That's point number one that was observed. Investor confidence. Of course, when something changes at the last minute, of course the market will react very negatively. This was one of the cases. And audit periods. Imagine how much ever we say that from a limited review perspective, we kind of do only inquiries, we don't do anything more than inquiries. That is what is needed as per the Indian standard, etc. Still, there is some misconception with the companies, auditors, for if you do 1, 2, 3, third quarter, you are already in a better position to handle the fourth quarter. Definitely you would have seen some of the significant transactions, etc. If something happens midway, that means for 3 quarters someone is auditing, the 4th quarter someone is auditing, when the actual audit reports are issued. So I think that is one of the issues. So basically I just spent some 2-3 minutes as to why this implementation guide came, then we'll get into the theory, because the theory is actually very raw here in terms of what is our responsibility, etc. This one case, I'm not sure whether you will be able to relate. I'm not again naming the company, but through the products you will understand. So this is a Gujarat-based company. So Gujarat it should be Gujarat only. Gujarat company. This company was actually selling fruit beverages. So you all know in Indian market, Maaza commands close to 28-30%. I think followed by Fruity, I think 15-50%. And these are all from 1980s, 1970s. They are in the business. And FMCG is not something we will be able to immediately gain market share. FMCG market generally, if you see, Nestle and Hindustan Unilever, Nestle and I think we'll take Nestle. I think Nestle, when they had this Maggi issue of the lead content, etc. Unless they are of that size, etc., they will never be able to bounce back. They were able to immediately bounce back to say this is the case. Coca-Cola, there were some pesticides discussions that came in the market, etc. They were able to bounce back. So FMCG, while it's a very, very consumer-centric market, but gaining market share really takes time. I think all of you will be able to understand that. So that's point number one. Here is this company selling fruit beverages, supposed to sell fruit beverages, competing with Fruity and Maaza. In their 3rd year of incorporation or their 4th year of incorporation, they are saying they are having 50% of market share when compared to Fruity or Maaza. That's point number one. Again, the prices, etc., were skyrocketing in those 2018, 2019 time frame. And there was one analyst. It used to be all these analyst reports. I think they were also trying to understand based on the press conference that was happening by the company. They were in fact taking all the leads, whether that is true. Can I go and check the market? Because this company is coming and saying they are focusing on the rural market or the semi-urban market. For example, not focusing on, assuming it is Tamil Nadu, not focusing on Chennai, but I am focusing on Coimbatore, Trichy, etc. Where that's my market and that's where I have 50% share. It is very quite. Someone is not able to correlate this. Something was wrong. I think the alarm was ringing for this analyst. And in one of the press releases, they have also told in one of the quarters, they are one of the, I think, category A customers with IRCTC. So, again, based on my reading, this is a very interesting case. IRCTC is supposed to have 3 different varieties of customers, it seems. Customer A plus customer A and customer B or customer C, whatever it is. For gaining customer A plus, it takes years. For coming to customer A, you will at least need 20-30 years. They are already claiming they are in customer A. And based on, again, when they discussed, and they were saying this is getting sold in all premium trains. I think there was some diligence that happened with the Vande Bharat trains, Shatabdis, etc., where this product was not even there. So the analyst first highlighted a point. Of course, the market slightly reacted to it. I'm not again quoting the firm, etc. The audit firm in May 18 resigned from this engagement, saying some reasons, preoccupied reasons, etc. Again, I'm adding some flavors to make it very interesting to this. Maybe it's not exactly the reasons, but they resigned, saying some reasons, maybe administrative reasons, etc. Then the other auditor started. He was doing for 1 year. After 1 year, that guy also resigned. So basically, what the market will observe, and these resignations are happening very close to the board meeting dates. So eventually, the implementation guide was actually drafted to say, look, what happens when these kind of midterm resignations happens. There's one other company where I think they had lot of exposure of group loans to subsidiaries. Those subsidiaries are having weak financial position. Again, the branch auditors, etc., didn't give the necessary red flags for the consolidator. Consolidator 15-20 days before is actually coming out. I'm not able to continue with the auditing. Again, a midterm resignation. So the implementation guide actually came into that framework in terms of how the market reacts for all these things and what is the auditor's responsibility. Among other things, when the auditor resigns, is there any responsibility he has first? So one of the points there is, if there is a fraud already identified by the auditor, again 2 points that are there. There's one implementation guide on fraud today. It says, if auditor was the first person to identify the fraud, then if the fraud or the suspected offence is close to 1 crore or more, etc., then he has a duty to report to the central government. Let's forget the form numbers, etc. But he uses the word first person. It's always easy to say that someone has identified, I have not identified, so always nothing gets reported. Now, specifically, NFRA came with another circular. This happened in July 2023. So what they told specifically is, whilst the stat auditors are under a mandatory obligation to report fraud or any suspicious activities, etc., it need not be the first person to identify. Basically, when I am auditing, something has happened, I've come across something, I'm aware of it, but I can't just resign from that engagement without even doing any reporting. So that's the point. So one of the firms had a challenge in terms of specifically resigning in between. So the NFRA circular very clearly told, resignation does not absolve the auditor to come to not report a fraud. Even if he or she is not the first person to identify the fraud. That's point number 1. So point number 2 is, he is duty bound even in cases he is not the first person. That is there. And as per law, the requirement to report to the central government is always there. That is what NFRA told. But the implementation guide which was there earlier, kind of told, unless we are not the first person, or unless we are the first person, we go on report. This was clarified by NFRA. Again, this is a space where there can be further guidances, etc. that can come. But as of today, this is something very, very critical for listed companies. For NFRA registered clients, this is very much there. So again, in that the fruit beverages company, what happened is, to take the example forward, I think 2-3 quarters this was happening. Both the auditors resigned. None of them reported any of these fraudulent activities. Finally, there was identified to be some corrupt malpractices happened, reported. They had challenges. I think the company had some challenges, some penal consequences, etc. That is there. But what eventually came out is these auditors were resigning without even telling that. So that is the reason why this implementation guide was actually introduced in 2018 and 2019. Primarily, that was the time there were lot many companies going out, maybe because of the COVID thing. I think March 20 is when the businesses were not actually doing well. March 20, June 20 quarters, etc. You already have some challenges in the company plus this additional challenge. Slowly things started coming out. So that's when this implementation guide came out. So any question there in terms of why this came first? I think that is very important. Then with that intention, it's very easy to understand what is there in the implementation guide. Just a 10-page document. Any questions? I'm not covering the Companies Act resignation. When I say Companies Act resignation, the companies can suo moto remove the auditor. But again, the central government approval, etc. This is not that. This is only the midterm resignation of the auditor by himself saying, no, I am going out. I've identified something, I'm going out. I've noted something, I'm not going to report, I'm going out. It's only speaking on that piece.
But you can mention that to the management also, is that the reason? The resignation letter.
That's there. Now earlier, the resignation letters used to be very, very simple, sir. You just say preoccupied reasons. The reason is health reasons. I don't have the capacity to audit, fee reasons, etc. What is the real reason? No one knows. I think this implementation guide specifically came for that. So again, it's very clearly was what this implementation guide it only re-emphasizes. Implementation guide is it just takes all the relevant extracts from the necessary auditing standards and it brings under this one gambit. One is SQC 1, that is the statement of the quality control standard in terms of complying with the necessary quality control standards at the firm level, etc. All standards of auditing, code of ethics and other relevant ICA pronouncements. One has to comply with all of these things. And there's a premise, again we discussed this premise there in the initial session. The management has certain responsibilities that are fundamental to the conduct of an audit in accordance with standards on auditing. Which is nothing but all information, whatever the auditor asks, he or she has to give. Any additional queries, clarifications, etc. has to be given. Unrestricted access also has to be there. So if these three things are not there, it can lead to a disclaimer because ideally it is nothing but a scope limitation. It only says these are all important, agree in the engagement letter. Ideally it is agreed. Now at the time of audit, if there are any challenges here, you may think of coming out of an engagement, or if not coming out, what are the reporting complications or implications? That's what this implementation date speaks about. So specifically, withdrawal may be appropriate for, again, essays speak about some situations. For example, on independence, say we conclude on a given date, the auditor's independence is already impaired. He or she will not be able to continue, because if you see the audit report itself, the name itself will be independent auditor's report. If we ourselves are not independent because of our quality, assuming I'm doing some non-audit service, it is becoming a prohibited non-audit service. Now, just taking economics and saying, yeah, I'm going to come out of the engagement. So that could be one of the reasons. Again, the standard speaks about it. And resignation or withdrawal while evaluating the engagement or client acceptance as per SQC1. What may happen is the company may have some huge operations, say in some place where there are some political instability or economic issues, etc. For example, say Syria as an example. You have, because there's one QRB observation which specifically had one of the companies, the whole go is getting signed, but the subsidiary is generating 100% of the revenue for the group. The consolidator is saying, I am running on it. This one such case. So there could also be a situation where we don't even know how the revenue is getting generated for the company, but it's done only at the subsidiary level. How am I comfortable with that? So these could also be reasons. Generally, at the time of client acceptance, whether I'll be in a position to actually do a good work from an auditing standard perspective. That is one of the points. And code of ethics, of course. Any challenges that is coming from independence, or any other professional matters. These are all the matters that is covered in the auditing standards or the implementation guide or the code of ethics. Very clearly say, if these are there, you may think of withdrawing. Otherwise, there are reporting implications. So very clearly it says, when considering resigning, first we have to consider the circumstances. What are the circumstances, etc., that is causing us to resign? comply with the requirements of the SA. Ideally, if there's a scope limitation, you are supposed to disclaim, not come out of the engagement. So it speaks about what the relevant SA, understand the SA, and see at the stage at which you are doing the audit. Generally, if you are in the initial phase of the audit, coming out can be an easy thing. But if you are in the very, very close end of the audit, etc., unless you disclaim, you will never be able to complete the audit engagement. So that could be one of the matters. And communicating with those charged with governance very clearly in terms of what were the challenges we had on an engagement, seek their written responses, etc. I'll come to it in the the next slide. So it's basically imagine a listed company, never come out after doing 3 quarters midway. I think that's the key principle that is coming out here. Any specific questions here before I get to the? No, I think these would be very, very easy.
Even if the management is not accepting for disclaimer, so in those situations,
so that time we'll have to come out only. So that time we'll have to come out, but specifically telling the reason we have not obtained sufficient appropriate audit evidence. We will not be able to comment without a disclaimer. So I am coming out of the audit. But all these things gets documented somewhere, where in the notice of resignation, and also in the ADT4, I think ADT4 or ADT3.
3 quarters limited review has been done. I mean, it is found out only in the 4th quarter that situation is arising. Then because SIRC is mandating that you have to sign the auditor balance sheet. So that will explain the auditor as well.
Disclaim. So that's where this has come. You have found out something in the last quarter. You are the person who is responsible. Disclaim it. As long as you comply with the relevant standards, there's no challenge. Comply with the standards and come out. That's what it says. If you say, first is, what is our responsibility when this kind of scenario happens? One, file form 883 and notice of resignation with auditor with ROC. So this is very important, the reasons to be specific. This is where some of the challenges were there. Avoiding the ambiguous reasons, something like preoccupation, personal reasons, which if assuming that is the reason, no problem. But if that is not the reason, there's something else, put the real reason, because there is going to be an incoming auditor who is going to accept this engagement. He should also know as to what has gone wrong in this engagement. Else he will not be able to do a correct job on his audit. So in that way also there's a professional courtesy, make the resignation letter on this 883 very, very clear. In terms of, instead of putting ambiguous reasons, have clear reasons. So this our reason should include whether there's an inability to obtain sufficient appropriate evidence, in our case which we spoke. There has to be a clearly identifying what we have not obtained, whether how it is important for the audit opinion as such. What could happen, for example, in a company which is a trading company, only purchase and sale is there, we have not even obtained any contracts with the customer, we have not even able to get any confirmations from the customer, etc. It is a pervasive impact, because the company is only a trading company, it's only purchase sales, and on sales I don't have any comfort. So we should be in a position to very clearly say what is the effect or a possible effect. Generally effect, if it is pertaining to one caption, say the investment is, or not investment, say property, plant and equipment is 150, we are not happy with the impairment, and if we say the impairment is, the value or the cost that is recognized in the books is 150, maximum what can go wrong from impairment is 150. So that's an effect. A possible effect could be, I'm not able to take it here. What can maximum go wrong is 150, etc. It can also be called as a possible effect. I think just see whether it's an effect of a misstatement or a possible effect. I think that is also something that has to be there in the resignation letter. I think what could go wrong. And then if the withdrawal is due to bona fide reasons, as I told, there could be some genuine reasons. First, the standards on quality control, if it says, the auditor's independence is getting impaired during the course of the audit, naturally he or she will have to come out. Auditor can be disqualified because of some reasons. He can become that, I think some examples that used to be there in company side, is not mentally stable, etc. It could be any reasons. So those will also disqualify. And again, from a resignation perspective, those also could be points. Those are all bona fide reasons. Bona fide, it is bona fide reasons. The most important thing is facts and circumstances leading to withdrawal. We should have a clear articulation of writing this to the management, saying, this is a scenario, this is what we have requested, this is what we have asked, this is what they have given, we are not comfortable with it. That has to be there. And if in case the management comes back with a revert, see the revert, analyze the revert, if the responses are adequate, let's see whether we can continue with the audit. If the response is not adequate, still state the fact and move it. That's what the guidance says. Again, we can seek legal advice if need be, but again, it's on the context of the no specific situations. If it is needed, seeking any additional legal opinion, etc. is also allowed as per the standards. So the last point is very important. So the professional obligation of the outgoing auditor to respond to any request for the incoming auditor. So unless the incoming auditor is aware of the challenges that are there in the the current engagement, he or she will not be able to take up the audit in the right way. So there's also a responsibility for us to put all these things in the ADT. All these things will be there in MCA website. One would be able to take all these things at the time of his or her appointment. So that is also important. This is the most important circular that came in 2019. In substance, it says, maybe I'll start from the last quarter. The first 3 quarters are signed. 4th quarter, we will have to definitely engage with the client, issue the reports and come out. That's there. If we are resigning within 45 days from the end of the preceding quarter, meaning for a September quarter, generally November 15th will be the deadline, assuming the 45th day is when the results are going to be out. November 14th or 15th, if someone wants to resign, they may move out. But on the 46th day, that is on November 16th, one may want to resign, he has to sign the next quarter also, December quarter also. Since he is signing December, he will invariably sign the last quarter also. So ideally this can only be the first quarter, only for June quarter. You can come on the first, but if you do second quarter, November 16th onwards, you will have to complete it because of the conditions. Yes, sir.
The management wants the auditor to resign. What reason?
So generally, maybe I'll take practically how it happens. Ideally, from an Indian scenario today, the auditor can only, the same thing. I didn't cover the Companies Act point. That comes under the Companies Act. From a Companies Act standpoint, it says the company will have to operate to the central government by giving reasons, etc. Someone has to be happy, etc. Then the removal of auditor can happen. This is from a removal perspective. Generally, what happens is, say for example, let me take 2 examples. Say there's a fee challenge. Say the fee is 100, 100, 100. Or historically, we were doing this audit where rotation is not applicable. And the numbers, the client was so generous and was giving 7-8% increment year on year, and it became a very sizable audit fee today. One may try to evaluate. I'm not into the rotation scheme of things, but again maybe I'll take a quote from other firms, etc. If someone maybe quotes 30%, 40%, why not going for the other auditor? That could be a point. So ideally what happens is we will share our efforts. We will say this is our effort, this is our ideal audit fee which we should have. He will say no, I'm going to go with only 70 or 60% as a case may be. If there's a binding between both of us, I don't think so we'll be able to do at that level. That is the reason. In this case, pursuant to a letter coming from the client to reduce the audit fee, I'm not able to reduce the audit fee. Accordingly, I'm resigning. So again, the reasons and the 883 has this point.
Another reason, before coming in.
I'll take that point. Again, I'll take one example of this private equity investor. Generally, these private equity investors, when they come in for a small firm, for a small company, etc., they always have a condition, a precondition where they say accounts have to be audited by a Big Four or by any other prominent firm, etc. Not saying Big Four, any prominent firm. They might have something. Based on their need. They may also say, I need this firm to audit. It can be anything. I'm just taking that as an example. Since that is happening, again, it will be a request from the management. So this is what is happening, and we would reply, pursuant to so and so letter, we understand your point, we should ideally come out, etc. But if these matters are documented in the notice of resignation under ADT3, the incoming auditor also understands what has really happened. In this case, the incoming auditor is already aware because he is going to take up the audit because he is getting pushed from the group. But in many cases, the other cases which I spoke, you may not even have the base of what really went wrong in the engagement. So this is primarily for those engagements. When things are going wrong, when the outgoing auditor is not really putting those points in the notice of resignation. So simply, the 3 points. 1, reporting of concerns to AC, disclaimer of opinion, others. Whatever is our concern, basically after, the first option is not resigning. Of course, we will contest with the management and not having necessary evidences, etc. So report to the AC. So So the AC comes back with their point of view, their challenges, their inputs, etc. Then we deliberate with the AC and communicate their views to management. I think this is what is happening from the audit committee's perspective. From our perspective, as long as if you don't have sufficient appropriate audit evidence and there is a scope limitation, naturally the route will go to disclaimer. I think this others is again from a SEBI circular perspective. The fact that there was a change in auditor, etc. This has happened because of this regulation, this circular, etc. has to be also attested by a company secretary. That is also there. But it's again a procedural aspect.
So the resignations in the case of CMDG appointments. So often companies are not cooperating with auditors.
CMDG. I have to check, sir. Not CMDG. But again, it will come under this ambit only, but unless it is required by law or regulation. If it is really audit, if the appointment is happening based on law or regulation, that law or regulation will define the cases specifically in terms of when resignation can happen, etc. Again, this is more from a general purpose financial statement perspective. In a normal engagement, in a normal audit of a company, if some resignation happens midway, how to cover it up? This is general purpose financial statements. But if there is very specific law or regulation that is really covering the audit, then it should be there. The relevant law and regulation should be there. I think this is something we have discussed, etc. There is one other thing. Maybe I have come across one interesting notice of resignation. I just thought I'll just share that. It's an NBFC. I have not done that, but I have seen that letters, etc. from an understanding perspective. See, I think in 2020 or 2021, the RBI came back with this NBFCs cannot be audited more than 3 years, rotation is 3 years, etc. What really happened is, since there's a mandatory thing coming from RBI, firms had to actually rotate out. And some of the firms, what they did is they in fact made it very clear in the notice of resignation, because of this stand Reserve Bank of India rules and regulations, we will not be able to continue the audit, and you give the notice 6 months in advance. And the management has time to necessarily search the incoming auditors, close it, etc. By the time the audit committee happens, the incoming auditor comes, the outgo, etc. The important thing is, when it is planned that way, the market didn't react. Resignation is never a challenge, but the midterm resignation and last minute resignation is where the challenge is. So we should also plan in such a way, if some resignations are inevitable due to law or regulation, as I told the NBFCs, then it is a very, very straightforward case of we reporting to the company at a very, very early stage, at least 5-6 months before, when we know. Finish the audit, and we come out, naturally there should not be any panic in the markets, etc.
Did you conclude the beverages audit which you were mentioning in the NFRA?
Yeah. So basically it is concluded to be having some correct practices. They are correct practices, but what really happened is it didn't come out of the auditors. No auditors have told. Ideally, the expectation was this particular point. You are during March, when you are supposed to sign the audit report. In the ideal, in that scenario, what could have happened is we wouldn't have obtained sufficient appropriate audit evidence. Either we should have disclaimed, but we didn't disclaim. We came out of the engagement. So finally, no one really came to know that this was there. It was actually getting highlighted by an analyst. By the time all the analysts really picked up, I think 2 auditors have resigned already.
Oh, sir, whether the financial statement showed a wrong picture?
Yes. So the concerned accounts had a problem. In fact, the second auditor, if I'm not wrong, had also made a mention. This is some 4 or 5 years old case. The second auditor made a mention that they had a scope limitation wherein the management didn't even allow them to visit one particular plant or facility in Vadodara. That also was specifically mentioned there. So it all boils down to the exact situations, etc. Net. So the midterm resignations was the challenge there.
But what was the observation with respect to NFRA for auditors in that case? Because the auditors are resigned now.
So this is this point. Basically, it doesn't absolve you for not reporting of fraud if you are not the first person. So the implementation came, then the NFRA came back with the circular. Net, someone has basically their presumption is you ask some questions, you didn't get the evidence. One way to argue is I can come out or disclaim. The other way to argue is I have come out, maybe I have understood something is wrong, but I didn't report that one level.
So they did not report.
They didn't report. So that was yeah. That's why he very clearly told coming out of the engagement. That is this. Resignation does not absolve the auditor of his responsibility to report suspected fraud as mandated by law. 143(12) specifically has this. So if needed to be reported, it has to be reported. Earlier the first person was there. Now even if you come to know, you report it and don't resign that way. Is what they were clearly telling. Yes, sir.
One clarification on the carve-out. So, one clarification on the carve-out.
You're saying clarification on carve-out?
Yeah. So, from financial year 24-25, for the principal auditor for an Indian holding company having components across the globe, so carve-out is not possible even if we have that coverage. Previously, if I'm right, 75% was the...
No, you're saying SAS from India perspective.
Yeah.
From India perspective, the holdco is also India.
India.
So the subsidiaries components also are from India.
Not all from India. So a couple of subsidiaries outside India.
The SA 600 is from a group financial statements perspective. Even if the subsidiaries are outside, SA 600 still comes into the picture because as a console auditor, when we sign console opinion, the group opinion, sufficient appropriate evidence, true and fair view of the console accounts has to be seen. So naturally, the subsidiaries elsewhere also comes into account.
So carve-out is not possible.
So as of today, carve-out is there, but the circular has come. It has just come. We have to see what's the interplay between SA 600 and how this is going to get concluded. SA 600 and this NFRA circular is not speaking to each other today. There's a carve-out possible, but what the NFRA says is there's always never a carve-out. The way we were interpreting is more through. I think you all can read it. It came on October 26th to be very precise. October 26, 2024. It's just a 5-pager document. If you read it, you will understand. It's a very self-explanatory document. It's only saying don't read only that standard. If you read from all the standards, etc., and also read SA 600, there's a broader view that you are already responsible for the group accounts, including components also. When you read that one standard alone separately, it looks like as if the auditor is responsible. As long as there is a clean opinion, we can take that from a carve-out perspective.
So in principle, we cannot issue a report carving out. That's the...
So today nothing has changed. So today from SA 600, our auditing standard is still SA 600. There's only a circular that has come, and it's been very clearly communicated. It is immediately effective. How SA 600 will undergo a change by March 31, we have to wait and watch. Most likely there will be a clarification. There has to be a clarification. So any other questions?
Forms, sir. Sample forms here, right?
Sample forms of? I have not taken. So what I have done is I have just brought these important things. So I have just told. Maybe if required I can take and share.
Right, sir.
Then the CMs too. Any other points? Any other challenges? Anything else? Sorry, I am just taking all these NFRA case studies, etc. Else, these two topics will not be making sense. You should know as to how it came, etc. But the topic was only the standards on auditing. But we will only be speaking the content. We will not know why it came. I think the why is more important in this case for these two standards. So if there are no questions, then that's it from me. Hand off to Mathangi. Thank you. Thank you all.
So, good evening everyone. I know we are all under pressure to complete our CPEs, but while doing that, these sessions are beneficial probably more for the speaker apart from the audience themselves, because I think when we see them we also understand, by routine we do a lot of work, but these are times when we actually focus on the standard, we read more probably and we learn. So, I am benefiting from this. I hope you also benefit from this session. So today the topic is on SA 315, which is identifying and assessing the risks of material misstatements through understanding the entity and the environment. Very relevant now because of the multiple scams globally we have faced. We need to understand what is a misstatement when it comes to financial statements, how big or how small, and how do you do a risk assessment even before starting an audit so that you are able to plan well for the audit, you are able to deploy the appropriate resources for the audit, if required, involve experts, etc., so that when you complete the audit, you are able to conclude that there are no material misstatements. So I'm not jumping into the standard yet. I just wanted to, probably introduce some of the very famous scams that have happened globally over the last 20-25 years, starting with Enron, and then we have our own Indian Enron of Satyam, and so many places where because of these risk assessments, there were material misstatements or errors, either errors or frauds which had happened and which were not unearthed, because of which the profession has been put in a very poor limelight, and probably investors have suffered, huge corporations have done these things. So just to introduce some of those cases which happened. So in 2001, when Enron happened, Enron had actually used a lot of off-balance sheet entities. So forget items, these are entities which are outside the balance sheet, and there were some complex accounting which was used, which was not unearthed at that point of time, because of which earnings were misstated, liabilities were unrecorded, there were hidden losses through special purpose entities, etc. And what happened in Satyam? Satyam was a backdoor entry, kind of inflating the revenues in the database in the back end. We have the latest one now on the audit trail, etc., where we say whether even the database can be manipulated, whether somebody can actually not make an entry and have an audit trail only on the face of it, but even at the database end. In this particular case, the entries were actually done at the database end, where the revenues were added, the revenues were inflated, and to show, where do you show that money? Then you have to also reflect it in the balance sheet. Obviously, when you are going to show income and you are not going to show receivables, you should have either receivables or you should have collected them. So the bank statements were fraudulently prepared and given, etc. Bank confirmations, we have bank confirmations, a special standard on that, and we also have mandatory confirmations, direct confirmations, etc. So each of these standards have come into practice because there was one big fraud which happened, and people realized that okay, you need those standards so that we don't use the loopholes in the system to defraud somebody. In Lehman Brothers, what happened? They actually used the repo 105 transactions and temporarily removed 500 billion in debt from the balance sheet, calling it as a timing error. Olympus was one other case. So if you go back to history, time and again we find over the years, in the last 20-25 years, big corporations, huge giants of corporations have actually manipulated their financial statements, some of them by error, most of them manipulations, by which they have defrauded the stakeholders in the business. So either they are the investors, or they could have been the suppliers, or they could have been anybody else, or the government by taxation, etc. So SA 315 is here because we need to understand the entity and the environment in which it operates, what are the controls which are there, identify those so that we understand which are the risks which will lead to material misstatements in the financial statements. So the focus is to understand the entity, and by understanding the entity, you assess the risks. And how do you assess the risks? So you have the old methods of assessing risks. Now you also have some modern tools and other things by which you can understand the high risk areas, the low risk areas, etc. And to see which have an impact, a significant impact on the financial statements. So those are the ones which we have to address critically. So what happens is, first we need to understand what is materiality with respect to a financial statement. It is again given by a separate essay itself. So it is material, a misstatement can be material if it has an impact on, it will create a wrong judgment in the reader. So the threshold of materiality can be big or small depending on the size of an organization. An organization which has a turnover of 5 crores, 50 lakhs is probably very material to it. An organization which has a turnover of 500 crores, 5 crores may not be material to it. So materiality is a very judgmental thing. So there is no standard to say what is materiality in terms of, it's not a fixed number to say 1 crore is material or 3 crores are material or anything like that, because it is really relative to the entity. So we need to first of all understand what is material for a company based on its turnover or balance sheet or etc. Find out which is big, and then assess the risk to see which are material for it and which could not be. So what are the common misstatements that we normally see? Some of them are very factual misstatements where clearly there are some inaccuracies, there is no ambiguity, some incorrect data entries, numbers, feeded, etc. Then there could be judgmental estimates, particularly where we have management estimates, like for example provision for warranty, etc., where there could be misstatements. And there could also be some projected misstatements where in a small population you have some errors or misstatements which when projected into a bigger volume becomes a bigger misstatement. So these misstatements can come because they can be deliberate or they could actually be errors straight away. So you can have misstatements, meaning you can have overstatement of something, you can have omissions, or you can have a wrong number put there, which can be due to a fraud or an error, or it can just be sheer negligence also. Somebody has not noticed something, somebody has forgotten about something, it has happened. And this will lead to business risk, you have financial risk, compliance risk and different other risks, but as auditors we have a bigger risk because I think today in this challenging audit environment we seem to be at the greatest risk when somebody does a fraud or anything like that. So just to understand what is a material misstatement in many of the cases which have happened in the past. In WorldCom, what happened was they actually overstated the assets approximately by 11 billion by just capitalizing the operating expenses, so they inflated their profit. So whenever somebody does something, we have to see what is the impact and where it is. In the case of Waste Management Inc., again the company reported about 1.7 in false earnings, which was not there at all. And finally they were, and they did not impair the assets which had to be impaired. Errors, these are all frauds because management has intentionally done something. Errors are unintentional, they have just crept into the financial statements, mainly because of oversight or lack of knowledge of something, or probably sheer some errors like processing errors or accounting errors that could have crept into the financial statements because somebody low down who is preparing something may not know what to do and they have done it. So in the case of Bank of America, they failed to account for 4 billion in capital, and while reporting on deferred tax liabilities. Groupon misapplied revenue recognition principles, not knowing how to appropriate correctly, and then including gross revenue versus net revenue reporting, and then they had to restate the financials. So these are some misstatements. Now errors are of different types that we can normally see. So we need to understand all this so that we know how to check for things, or understand what kind of errors and misstatements happen. So you can have mistakes, can be like you can have data entry mistakes. So transposition, where numbers get interchanged. Second digit becomes a third digit or whatever. So those kind of errors, the reversing numbers can happen. Then transactions can be misclassified. For example, a capital expenditure gets accounted as a revenue expenditure or vice versa. Sometimes personal expenditures of owners, promoters, businessmen gets accounted as business expenditure. Those kind of errors happen. Then accounting principles. So on and off now we have new accounting standards coming in, revenue recognition, etc. You have a latest revenue recognition standard. Then you have something on insurance now which is going to come up under Ind AS. So you have different new standards or something coming in, so people don't understand the accounting principles. Very often in 109 we find very difficult to understand the accounting principles. Complex instruments are there, so we may not understand the accounting principles because this, these cause some errors. Then omissions, somebody does not record something in the accounts and it gets missed out and it does not happen. So those are possible. Then miscalculations, purely arithmetical computational errors which could creep in. Say for example, when you do depreciation, some wrong useful life or something, one number replaced, and year on year we probably carry on with the same last year's file and we do the work, and then the error becomes bigger and bigger. So those could happen. Then estimates, for example, provision for bad debts, or the CCL provision now which we are making on all financial instruments in the Ind AS. provision for warranty, even provision for gratuity, etc., because those are also dependent on the assumptions that are being given for the estimates to be made. So in any estimate we could have errors. Currency conversions. So MNC organizations or organizations where you have imports, exports, etc., where conversions does not happen at the right rate or anything, then sometimes duplicate entries are there. Very commonly, for example, in gratuity you can find in many smaller organizations where they may not have a system. When they make a payment of the the gratuity to LIC or the fund where they are maintaining it, they debit the P&L. Again, they make a provision also without adjusting the payment, etc. Very commonly we see such duplicate entries in accounting, sheerly because of ignorance. Errors in consolidation. So what happens is intercompany transactions do not get eliminated, profits on stock transfers may not get eliminated, etc. So one particular organizations where we have seen an audit, the entity, it is not a company, it has about 700 units. The audit is actually handled by C&AG, but before that, the audit firms also audit that because of the number of units there, it is a not-for-profit organization actually. There, I think they report a turnover of 500 crores or so, but the real turnover, if you see, is only around 350 or 400 crores. About 25% of their transactions is inter-unit, which does not get reported, and C&AG has time and again been complaining, and they have been saying that it has to be done. All because they don't have a proper accounting system. So when you have large number of units and somebody does not monitor or account this properly, the inter-unit gets missed out. So stock transfers happen, inter-unit also sell each other at profits, then you don't eliminate the profit from the final inventory. That is quite common. I think many people don't even understand how to eliminate that inventory in a stock transfer in the inter-unit. Other than that, the regular sale or purchase transactions which don't get eliminated. So, overall, there is a presentation of both assets and liabilities, income, expenditure, etc. That happens. That's very common. Compliance failures. So, improper tax rates or not paying or not accounting for certain liabilities which are there, demands from income tax or anybody else which is not accounted. Not only income tax, any other regulatory demand which could possibly be there. And system configuration errors, which many of us find it very difficult to understand. For example, if you go to banks, every bank will tell you, oh, we are not computing this, it is coming from some system. Very common reply you will hear in many places where the systems are very, very sophisticated, and we are always told that the system does it. If you go and ask in a bank, if you actually do an interest computation on an ordinary loan case or an ordinary case, and you find a small difference, ideally in a bank you should not even find a single paisa difference, considering the type of systems that they are supposed to be having. You will rarely be able to make them pass an entry or anything at the branch level or even at the regional level, because they will always say, no, there can't be an error, this was done by the system. So somebody has already done. Very frequently, all of us will hear this in financial institutions, etc., where your manual computation, which actually should be perfect, you will find that it will not match with the bank, or mainly because I think probably they don't update the interest rate at the right time, or they have not accounted something with a proper value date, etc. But very clearly they will put it on the system and say, this is a system error. And then of course adjusting entries. So again here we have lots of cases where people, big corporations have done accounting errors and have, they don't get away immediately, probably they get detected much later, but huge values. So Toshiba had overstated profits by 1.2 billion over several years. So this included some intentional part, but also some clerical errors, etc., where improper numbers were, incorrect numbers were put. Tesco had reported profits again due to errors in calculating supplier rebates, etc. Wells Fargo had done the same thing while doing properly, upper tax compliance rules. AIG had done similar things. So Freddie Mac had done something in the past in consolidation, etc. So very commonly these have been reported. So these standards have all come mainly because of these things. Only thing is, how do we address these errors? How do we find out whether these errors or mistakes or misstatements have crept into the financial statements that we are auditing? So basically this 315 is about understanding, assessing the risk of these misstatements. So we have seen more than enough misstatements happening across the world in big corporations, even in all the companies that we are auditing also. So how do we ensure that the financial statements are not materially misstated? So what do we do at that point of time? So we have to evaluate the materiality at the time of planning itself to ensure what could be treated as a material number for this, for the group level. In fact, while you are going to be looking at SA 600, normally what happens is the lead auditor will give the materiality for the entire group also, because materiality will happen at two levels. Individually at a particular event alone or a particular transaction could be a material transaction. Sometimes individually they may not contribute to a bigger number, but a group of entities could again be something material, because of which you may have to pass the entry. So generally what happens is the lead, or particularly if people are doing MNC audits and the auditor is a big four or the bigger firms, internationally the head office is somewhere. This SA 600 is new to us in India now, and it has been postponed for a long while, but in all these companies where the head offices are present outside India, in those cases we would have seen where we cannot share our working papers, etc. So they send an entire audit pack which is similar to our own set of working papers, where we have to do all their assessments and tell them how we have gone about the audit and etc. So the materiality is the first thing that will be considered, because your the results of your risk assessment and your audit procedures, etc. will depend on the materiality. So at what point of time are we going to stop audit, till which number are you going to look at and consider for passing entries, etc. So this is the threshold above which a misstatement in financial information could influence the economic decision of the users. It can have quantitative factors, which are basically numerical thresholds based on financial metrics like profits or balance sheet size, assets, etc. Or it could be qualitative factors. For example, something regulatory and compliance, you cannot really look at whether it's material or not. You have to take everything into consideration. So how do we do this materiality? Though there is a separate standard for that, I just wanted to talk about it because the risk assessment and what we do for planning actually depends on the materiality, which is the first step of the planning for the audit itself. So to determine what is a misstatement itself, for non-profit entities, you could look at total expenses or revenue or something like that. For profit entities, you can look at pre-tax incomes, revenues, total assets or equity, and use a set of percentages. Financial institutions will be net assets or deposits. So something which is a number which we can audit and look at and drill down to that level. So 5 to 10% of probably pre-tax profits, or 0.5 to 2% of revenue or total assets, or 1 to 2% of total expenses, very, very indicative. So you could look at 0.5% or 1% of revenue or whatever. For your own firm and everything, set up some standards so that all your audits you look at that as a materiality uniformly across all audits. So generally audit firms will have something similar to this set as a materiality level for their audits. So please use that, and once you have determined, you can start your analysis after this. So for some items materiality is not really relevant, and you should probably use lower thresholds. So you have 3-4 benchmarks, because what happens, you're going to look at profit. What happens if a company or an entity is only doing a loss? Then how do you look at it? So in those cases, you look at it as absolute numbers, not necessarily as loss, or use the revenue or the assets, this thing. So generally what we normally do is, personally in our audits in our office, what we do is we determine based on these 3 factors, on profit, revenue, assets, and we take the lowest number as the materiality and we use for the audit conservatively. If it was a loss-making organization, there is no profit number, then use an absolute number and determine that, because for a loss, then I think every number becomes a material number. So in those cases we use absolute numbers. In case of some specific matters which are very sensitive, like related party transactions, executive compensations or regulatory compliance matters, etc., we generally don't go only by this materiality number. We actually take a lower threshold and work on it, because I think they are significant risk areas. And in case there is a fraud or anything which is detected in the company, identified and reported, then I think materiality, wherever there is an intentional thing that has happened, then we should not go by these materiality thresholds. Probably we should look at lower thresholds. So this is just an example of a materiality computation. Pre-tax profit of $5 million and revenue of $100 million. So you take pre-tax profit, 5% of 5 million, $2.5 lakh and 75% performance materiality for that, which we look at it as per transaction, everything is 1.87 lakh. So in this case, if there was a $10,000 over or understatement in advertising expenditure or something, we will identify it, but we will not ask the client to pass an entry or anything, because it is not material. So coming to 315, once you have determined this materiality, this which you can do based on the last year's financial statement or the current year's financial statement, which you receive upfront when you start the audit itself. So at the planning stage itself, understand the materiality and keep it ready so that you will be able to look at the other risk assessment procedures. So what we have to understand as part of 315 is to understand the entity's operations, the industry environment, the regulatory environment, the business environment in the country, etc. And the advantage is that your audit can become more effective. You know the areas to focus on and do the audit, instead of randomly looking at all the areas and spending more time on a less significant area and spending more time on a less significant area. Rather focus on critical areas. So to start with, how do you do the planning itself? So generally what you do is you try and understand the environment in which the entity is operating. So normally while you do, before you start the audit, the audit team sits and discusses, does some research on the company's industry, the regulatory and external factors that are affecting it, etc. For example, if we were to look at financial industry like NBFCs or anything, you will be looking at RBI regulations and required matters. So regulatory compliances. Insurance companies, you will be looking at IRDA and those regulations. So always it is not only Companies Act which is relevant for regulatory, it could also be other things. So FEMA could affect companies if they have overseas investments, or they have downstream investments coming in, or they have exports, etc. So first of all, identify which are the regulatory frameworks which will apply to that company based on the company's business, etc. You need to understand the company's operations, ownerships, how is the governance. So generally if the management and governance are good, the chance of these material misstatements become lower. Governance is very important because the culture tone at the top is very important. So some discussions with the management will help you understand how well they are toned towards this regulatory or other compliances and governance perspectives. Then the types of investments the companies has made, which are their key products, which are their services, what is their business model, etc. Then you can talk to the management to understand their strategies and what are the business risks which they perceive. So as an auditor, we are going and doing a risk analysis, but before that I am sure the promoters have an understanding of what are the risks that apply to their environment. So talk to them to find out what is the key challenges or what are the critical regulatory and other compliances and everything that they face, so that you will know what is there. You have to understand their competition, to understand the, as you look at the financial statements, to see whether the company is under any compulsion to report any numbers. Like for example in Satyam, the promoters had actually pledged their shares in Satyam to take borrowings. So if their borrowings had to be already always covered by the security, the management had a compulsion to ensure that the Satyam's share prices were always high. So that was their motivation to actually, increase their revenue and consistently keep it higher and higher quarter after quarter. So we need to understand whether there are any compulsions the management may have to, misstate anything, or compulsions to do, increase their revenue or decrease their costs. For example, if there is a going concern compulsion, then they may, or there is a borrowing or something like that, then they may be compelled quarter after quarter they have to show some results, or year after year they may have to show some results. So these are possible. So we need to talk to the management, we need to talk to the top business heads, etc., to understand their business. This is very important for us because we are not experts in all these things. So we need to understand what happens within the company and whether they are facing any difficulties or challenges which may compel them to do anything. So that is very important. That is the first step. That is understanding the entity's internal environment and also understanding the regulatory and other requirements which they face. The next thing that you will have to do also is to look at the business operations. So what are the key activities and processes? So core operations of production, sales, marketing, distribution, all that we need to understand. So you will know which are the expenses and the revenue streams that the company will have. It's a service company or it's a product company, or they do both. How are they marketing and selling their goods? So are there, you will understand the expenditures which will also have to be booked. Is there a distribution commission? Is there a discount they give? What happens? How do they book everything? So if you don't understand business, we may not understand the revenue streams or the costs which are involved. Then are there any specific transactions or complexity for that year? For example, they could have done a merger, or they could have done an acquisition, or they could have hived off the division. There could be a discontinued business operation, etc. So we need to understand that. Then you also need to understand what are the industry dynamics at that particular point of time. So now you have these tire manufacturing organizations and others where they have to resell or recycle the tires. Now there is a latest standard which came in only last year. There is a regulatory requirement which says that they have to buy some credits, just like buying carbon credits. For this recycling they have to buy some credits. This is regarding the pollution and other things which they may be causing the environment. So that is based on the amount of rubber they have used and produced, etc. So each industry, suddenly there will be some regulation that comes like this. So we need to be updated with the business to see what comes up at that point of time, so that you know that they are going to account it or not. So this, for example, this provision for warranty has not been there forever. I am very sure warranties have been given for a long time, but these entries for making provisions for warranties probably has been happening consistently. Now all of us have been pushing probably in the last 15 years to 20 years. Even before that, companies had been giving warranties, but many people, many companies did not account for a provision. Mostly they only accounted it actually on a, when you actually incur it. On incurring they used to be doing it. So these provisions started coming when more and more replacements were happening in the industry, and there were stricter norms for recall, etc. So now these pollution control boards, for vehicles also you have the latest BIS standards coming in, etc. So sometimes we need to know these, because only then you will know whether the companies will be able to sell, for example, auto or two-wheeler manufacturers, whether they will be able to sell the old vehicles, whether the old parts will still be useful, whether they are compliant with the pollution norms, whether you have to replace them, whether you have to write off them, or they can be maybe repaired, or if they are things like that. So in many cases the new norms which come in announced by the government, or probably compelled by internationally some standards which come in. So those could affect your costs or your revenue streams, they could affect your inventory valuation. So we need to understand all this environment and the business before we start the audit, so that you will know whether those are all accounted for or not. Then the organization structure and who makes the decision process, decision making is at whom, so who's the management, etc. And how centralized or decentralized the operations are. Many times you will find that there could be a combined system of certain things being centralized and certain things being decentralized. So when it is a question of centralized and decentralized, you need to know where the controls are. So if it is decentralized, is somebody centrally verifying things which are happening, accounting partially which is happening at the branches or at the divisions or whatever at the different locations? How is it verified and combined centrally? Then do they have a proper accounting system? Are they using something like Oracle, SAP, where there are more controls, or whether they are using Tally, or whether they are using some other system? How are they controlling all this? So you need to understand those also. Then key stakeholders, whether there are customers, suppliers, investors, creditors, etc. So you will find that in many cases customers could impose some restrictions on companies. Like for example, the the trucks and the trailers which carry the Maruti cars from north to south and bring them here, generally Maruti insists that the trailers and trucks have to be owned, and they put some specifications on these cargo carriers. They say that the vehicles have to be owned, the vehicles should have certain specific requirements of dimensions which are suitable to bring the vehicles from there. And they put their own standards of saying at what speeds the vehicle could be driven. So many conditions which Maruti imposes on their cargo carriers. So we need to understand that, because tomorrow what happens is, in case we have say taken vehicles from outsourced vehicles or whatever on hire, and you have used them, and Maruti comes to find out that something like this has happened, Maruti could actually impose a penalty on the cargo carrier and say that you did not comply with the norms which are set out. So all key customer agreements, vendor agreements, etc. also have to be read, because there are many times these conditions probably not satisfied could lead to a lot of penalty. So it is very important to understand all the key metrics, key agreements, employee agreements. For example, even employee agreements. For example, recently in one of these companies which I was looking at, had a US holding company. So they had actually issued a something similar to an ESOP, but that was a cash settlement which was to be made to the employees, some only key employees, not all of them, based on the performance of the US holding company and their share prices. So in this particular case, this was an audit which was transferred from somebody to me. I got the audit this year. When I was going through these papers, I realized that there is something which the US company had promised. Now this company had made a promise some 3-4 years ago. So normally it was an ESOP which was issued in India and we are aware about, we would have actually accounted for the costs over the period of the ESOP, from the vesting period and all that. From the grant date we would have started accounting for it till the time it actually converts into a share issue. Now in this particular case, the company had not accounted for the employee compensation in that case. So when I questioned, asked them, they said this was very accidental. In fact, at the end of the audit I found out, after going through all the papers and reading and understanding, they said, okay, these people will get additional compensation next year, we will pay them cash when it comes. I said, okay, who is going to bear the cost? It's a cost plus model. So India actually pays and then finally bills it on the foreign entity, outsourcing manpower, etc. So in this case, okay, but then finally you have not booked your cost every year. I said, no, anyway we will get the money when we are booking the cost. At that point of time we will take it. And we don't know whether the holding company will make a profit or not. So we are not accounting for it. Okay, where is at least some probability? Do you have 50%, 70%, something do you have in mind? Or where you have announced a scheme, so why are you not accounting for it? Very simply because they are going to get it reimbursed at cost plus, they have not accounted for it, because per se in India there is no impact on it. But going by an accounting principle or something, then we have to tell them, no, you account for it, a significant amount. And it is not, many times we are also, we are told, okay, these employee contracts are very confidential, so they won't share with us, etc. Sometimes very difficult to find out also whether such things are there. In this particular case, I think I was fortunate to find out, so I could tell them to pass the entry. But these papers which appear to be very, very irrelevant are actually relevant for us to understand that there could be lot of hidden cost expenses which are not being booked by the companies, booked by them only when they feel that there is a actual cash payout or something. So though we are all in accrual system, still the mindset is to account for expenditures in many cases not on accrual but when it actually happens. So this understanding of probability and partially accounting for it or whether it will happen or not, etc. It is not fully sunk in with the managements in the many of the smaller companies. I think the larger MNCs are very different, but the SMEs I think still go on that say, okay, why should I do it? When I incur it, I will pay for it, I will get the expenditure. Today I book for it, I may not even get a tax exemption or anything on it. I still have to pay tax for it when I make a provision. So that is the intention with which accounting happens. So we need to understand what are these provisions that will probably apply to account for these expenditures.
How did you find out, ma'am?
This was going through all the bunch of paperwork that we have.
Since the confidentiality, they won't be sharing.
Correct.
So they made the provision also.
Yeah, we made them make the provision. But like I said, it is like while we are discussing and then we are saying, oh, this person came from a company which was merged into this. Okay, so what are you compensating? Oh no, we are not compensating. US is going to give them later. But then how will US give them later? Oh no, ma'am, they will pay cash. When they tell us, we will something like that. It was on a discussion that we started and then we had to get the paper and we had to get something, it is. So these discussions are very, very important to understand, at least for all the key people, key vendors, key customers, to understand with the company to see how the, the business model is or how the, payments happen. In many cases, you will see these penalties and all, nobody understands or, it is all in some paper. Only when it is imposed, we account for it. We don't know whether it will happen. For us to understand whether it has to be accounted, we need to understand whether there is a non-compliance with any of the provisions. So till we see such things, we may not know. So it's very important to go through all these documents. Also visit the facilities and the operations in different places to see how they are actually doing it. At least once we have to visit all the factory sites, etc., to know what is happening. Any engagement, it is not only statutory audit or anything, any engagement I think we need to do that. Even if it's a valuation exercise, we need to do, look at all the different places where the businesses are conducted. Then inspect typical documents like strategic plans, budgets, etc. So to understand whether everything has happened as they discussed or whether something is done and not accounted. Then use analytical procedures like trend analysis, ratio, industry benchmarks, etc. So, and then look at historical data. So these analytical procedures, what we normally do is we look at some variance analysis with the past years, whether companies, every number, you try and look at it with compare it with the last 2-3 years. So you will know whether there is an increase in revenue, whether there is an increase in cost, whether there is an increase in gross profit or a ratio or absolute numbers or whatever. To see anything significant, say anything above 5% or anything above 10%. So if there is a revenue increase above 5% or 10%, company should be able to see whether it is a volume increase or whether it is purely a price increase because of inflation or how that increase has come about. So that the management should be able to explain, and then you will suddenly find that, oh, we started a new facility, now we are producing a new product or we have started a new service. Such things will come to light when you ask them, sorry, where did I go? Such things will come when you ask them on how they have increased their revenue or increased their costs, etc. So we do some kind of a variance analysis across the years to see which are the increases and decreases. All increases and decreases say above or by 5%. So either it goes up or it goes down by 5 or 10%. We ask them to understand what has happened. Then we go in detail, but this is at the planning stage itself. So and then industry benchmarks also. So for example, to put up a solar power plant or something, maybe you required a 4 crores or a 5 crores for a 1 megawatt power plant. Now this company has invested so much in power. So you will know based on the capex what is the ability that they could have to produce power. So things like this which are possible to measure, we can look at it. And then also look at the past financials, etc., audit reports, then internal audit reports, internal control questionnaires, ICFR, all that to see which are the areas. And the next thing is to understand the control environment in the organization. So first we understand the business, then we need to understand what are the controls they have. So first of all, does the management have a good corporate governance system in terms of, are they for doing the right things, or they think, oh no, it's okay, it's not important enough to do something right, it's okay and make, they are okay to not do some things correctly. Are they willing to adjust? Are they willing to pay off the departments for compliance? Are they willing to manage the non-compliances? So what is the culture at the top? That is very important to understand, because that will say what probably we'll be seeing in the companies. We'll see some big companies, which are very, very conservative and would like to follow everything to the T that every regulator says. There are yet others we will find who are okay to flout the rules, say, oh no, when it comes we know how to manage. So what is the culture at the top? And does the company itself do some kind of a risk assessment in terms of what are the key risks that they are facing, how do they manage it, etc. In what is the information systems and the, today it is all computerized environment, we need to understand controls also come from the system itself. So how well are they recording the transactions? Is there a maker-checker concept, whether system automatically controls the transactions? Like for example, there is a document management system, so there is a system by which you cannot edit any transactions. Then there is a approval system where somebody passes the transaction, somebody higher up approves it, etc. So there is a level of control which is happening in the system we need to understand. And does the company itself monitor, like for example, do they have MIS or something like that where they are continuously monitoring how the business is happening, whether somebody is looking at the receivables, whether somebody is looking at the tax liabilities, etc. So is the company interested in reviewing its own performance and its own issues that they are facing, the risks that they could possibly face? So that also we need to understand. So once you understand this, we move on to identifying the risks of the material misstatements. We need to see which are the inherent risks, which are the control risks, and then based on that we need to determine the audit procedure. So we could do that in your different tools are available. Excel being the simplest tool which we normally be using for doing some of the analytics, but there are also other different analytical tools which are available for audit now. So I use something called as an idea, but I think the big fours have better tools. So I think Sriram can elaborate on that at some point of time. Then we also assess based on inquiry with the management and the staff, and of course observation, inspection, etc. So some are very, very rudimentary tools that we have been using forever, and some of the modern tools which are available now, which will very clearly throw up all the discrepancies. When you put in the trial balance, I think these systems will be able to say these are the areas which are probably areas which we have to look at. Like in idea, we can put in the all the journals and everything. It will say, okay, look at these vouchers or transactions. There appears to be some kind of a pattern, etc. So the software will throw up something which also helps us to see those specific things to understand whether there is any fraud or any misstatement that is there, error. So the analytical procedures that we talked about is the first thing, which is a sheer increase, decrease from previous years. Then identifying risk of fraud. Fraud risks are actually a subset of the risk of misstatement. So which are the areas probably which are more prone for fraudulent reporting. So those also we should do. So basically what we do is we do a planning in the office before we start the audit, and we have to document all that planning process also, because NFRA time and again has come up and said, okay, you said you have done planning, but where is the documentation? Have you minuted the meetings? Have you minuted the documents? Or have you minuted the risks which you have identified? So those have been reported by NFRA in their reports. And consider some of the fraud risk factors. So if there is an incentive or a pressure, then management bonuses are tied to financial targets, then possibly somebody can actually fraudulently manipulate the revenues. Where there is a high employee turnover or there are very weak internal controls. For example, the same person does the maker and the checker job and there is no control at all, etc. And then whenever there is a justifiable or questionable accounting practices and you go and discuss with the management condones it and says, oh yeah, we are fine, we know that this is happening, they told us and did. As if an employee telling the management and doing something is the right thing or whatever. So that does not justify something. But these justifications from the management will clearly tell us the attitude of the management. So those are also important. So when the management has an attitude like that, then fraud risk factors probably you have to see at all levels. Then we also look at the past audits and findings which we have. So internal audits, control, concurrent audits, whatever has happened. In case of NBFCs, etc., or any regulated enterprises, we can also see SEBI reports or RBI reports, who they spend their inspection reports, etc. also will be there. So time and again RBI reviews all NBFCs on a periodic basis or whatever. So in those places, I think we can also look at the regulatory reports which have been issued. Then our own audits, what we did last year, probably there were some misstatements, everything which were passed down or areas which we identified to look at in the current year. Some things which were resolved or which were left open, not exactly open as a query, but more as a open for an action to be taken or a discussion to be done and resolved. So those things which we can see. Then where management judgments, etc. have been challenged. So this could have been challenged by the income tax department or by the PF authorities or anybody else. So these estimates, etc. those also we have to see. Then we have to look at some of the key risk assertion risks basically. So whether something is complete, whether all the liabilities have been accounted. For example, you do a monthly expense, you map the expenses, the whole year's expense into months. Then across months you will know whether for all the months, for example, all salaries have been provided or whether rent has been provided or recurring expenditure very easily you will be able to see. Then there are things which should happen every year, then you will know whether it has happened for the year or not when you look at the previous year and the current year. So many times, the year-end cut-off procedures may not be followed, so provisions may not have been done. You will find this income expenditure mismatch, etc. Because expenditures which are paid for March and April, probably some of those have not been provided for. So in those cases, you just slice your P&L into a monthly P&L. You will know which are the expenses which are recurring, not accounted, etc. And you will know whether everything has been completely accounted or not. Then existence. So existence is about whether you have an asset itself or not. Without having an asset, whether have you accounted for some assets or some sales which didn't happen but you have booked the sales, things like that. Then valuation, like inventory valuation, etc., where there could be large misstatements. Now with Ind AS you also have financial instruments which get valued, so there could be misstatements in the valuation. And then whether rights and obligations, whether you own the asset or not, whether it's a leased asset or whether it is your own asset. We are also talking about now in Caro about Binami transactions, etc. Whether the assets are yours or whether your assets is held by somebody else. Are you holding the title? Somebody else holding the title, etc. So all these are also areas which you will look at for key assertions of risks. And then you will also look at some complex or non-routine transactions and look at some special transactions that would have happened in the company. So probably some huge acquisitions would have happened or some disposals or merger, demerger, something would have happened. Then suddenly there could have been some big impairment provision that has happened. For example, some accident or something that happens not covered by insurance. Some asset is destroyed, factory building or plant and machinery which have been destroyed or something like that. So you go and ask the company, they will say, no, we are replacing the asset, and then they will say, oh, there was a fire, so why did you not account it? No, we are anyway replacing it. So things like this you will know by visiting the plant and also looking at some large accounting that suddenly happens, non-routine accounting that happens. If you look at it and ask them, the management will give you some leading answers from which you will have to start asking the questions. There could be some complex contracts or leases, for example, non-cancelable leases, and you vacate the premises and then you have to account the entire lease expenditure. So these are things that, some sheerly from nature of the transaction, if you look at it, you may find such things. And then once you have identified some of these, you have to look at it whether they are material or not material, depending on the size of the transaction with respect to the company's overall size. And then you have to decide whether there is any impact on the regulatory aspects, income tax, companies have pollution control, or any other regulation, RBI, FEMA, whatever, or financial covenants with bank borrowings, etc. So you can also ask the management certain things like whether any accounting policies are being changed. For example, investments, how are they accounting? Till now they could have accounted in FIFO or something, now they decided to go for weighted average. Such things can have an impact in the financial statement. So we need to understand whether any of the accounting policies are being changed. Estimates also, useful life estimates could be changed. So such things we need to find out. Then what we need to do is, there are some inherent risks for each of the services or companies, or depending on the business, etc. So inherent risks is the susceptibility of financial statement or material, assuming there are no related controls. So it is also dependent on the type of transaction, account balances, disclosures, etc., and could be influenced by both internal and external factors. So something like high-risk industries, for example, financial services, NBFCs, etc., where you may have some derivatives or some hedges, etc., which we don't understand. Then in real estate, inherent risk will be valuation of properties, whether they are sold, whether construction, contract, accounting, etc. Then technology. Quite often we have this R&D expenditure. Whenever we have an intangible or an R&D expenditure, we are left hanging high and dry. We don't know whether it has to be an asset, or whether it is in the research stage, or whether it's a development stage, whether it has to be written off, whether it has to be kept as an asset. So based on the nature of the industry, there are specific items which are always high risk items, which we have to see. Complex, unusual transactions, which are also leading to some of these inherent risks. Then subjectivity and judgment, where like management estimates for impairment provisions, even for these gratuity or these provisions also, because they are all dependent on the assumptions that we give the actuary, based on which you will get the estimate itself. Then fair value determinations also. So in all these cases we have risks. For example, the asset valuation could be wrong, or there could be some economic fluctuations which have some sensitivity to that, or there could be some inconsistent accounting, or there can be error or bias in applying the estimates, etc. So those are the risks. So depending on each industry, you look at areas which are high risk areas, and also associated risks we have to identify. So this is another way by which we identify some of the risks. Then derivative and structured products and investments in unlisted entities, you can have misvaluation due to complex pricing models, or some there could be there may not be transparency in some of their disclosures, etc. Then disposal of significant assets or investments, susceptibility to fraud. For example, the loan covenant could say that every time you have to make a profit, otherwise the borrowings could be recalled for, or something like that. Then the management is forced to show profits every time. Then you have cash intensive businesses with high risk of misappropriation, like for example hotels, hospitals, hospitality sector in many places, etc. Then accounting estimates and assumptions. So bad debts provision. So in many cases people are not, management is not willing to make these provisions. So similarly for tax also, when you have to pay under duress, or when there is an dispute or something and they have to pay, they pay, but they are not willing to write off, whether they have to make a provision, whether they have to make it as a contingent liability or just pay and keep quiet, what you do. Asset valuation, quite often, the useful life of the plant and machinery, many cases, smaller entities go by what is given in the Companies Act or something, and they generally follow that same useful life. But probably, a technical evaluation will also help. See, for example, in insurance, generally there are two values by which they insure. One is they will go by the book value, where they will only offer a lower insurance. The other is where they go by a replacement price, etc. So in these cases, I think technically also the insurance companies will ask the companies to evaluate their value of assets, etc. So that is a way by which, if those reports are available, we can see whether any of the machinery have become obsolete or anything like that. Then impairment testing for goodwill or intangible assets, investments and subsidiaries, all those also we have to see. Revenue recognition, very commonly in real estate or wherever there are contracts which are done over a long period of time. So percentage of completion accounting is followed, then we don't know how much should be the revenue at all is a big question. Then sales, rebates, discounts, returns, many of these things we find that there could be accounting errors or anything in that. Then compliance with the labor laws or tax laws, industry specific regulations could be there. Environmental obligations, today we are talking about a lot of sustainability and things like that. So we are going to have more and more environmental obligations coming in. Mining companies have this pollution and other things. So a lot of these industries are already regulated, but more will come in. Then currency fluctuations. So what happens to them? Are they hedged? Are they not hedged? What is going to happen? Like for example, I think 2 years ago we had this euro-dollar parity. So generally, $1 is not equal to €1 at all in terms of rupee value, but at some point of time both of them came close to 80 rupees. So at that point of time, if you had the euro was coming down and the dollar was going up, basically. So if you are going to have imports in dollar and exports in euro, you are going to face challenges. So wherever companies were doing natural hedging had to resort to paying and getting it hedged, taking some forward contracts, etc. So in these cases, accounting is a mystery. We need to understand how to account for all these hedges, etc. Then consolidation in complex group structures where there are multiple subsidiaries, etc. Investment properties which are subject to fair value adjustments. So some of the inherent risks, changing of accounting standards. You have new standards now, revenue recognition came, 109 came, when they all came, when this ECL thing came, a lot of new things had to be done. So first of all, there is a gap in understanding of what is to be done and what is required, because these guidelines and everything are published much later. Originally when the standard comes, all of us have limited understanding of what is to be done. For example, the GST notices we are seeing now, not related to this though, but 17-18 when they came, all of us, I think the first stand was to say that whenever you have the ITC for the input, when you have the invoice in hand, you can account for the ITC. Now the department has sent notices to everybody, asking everybody to reconcile the GST reports with the returns with the ITC and actually give them. So these are all things which we learn in hindsight only, but when something first comes in, all of us have a doubt on what to do about it. So those are the times when possibly errors will creep in. Then going concern and financial distress. In many cases, companies are continuously making losses, management keeps supporting. Sometimes because of a regulation or something, companies could actually go into a, they could be disrupted and they could actually be required to be closed down or whatever. So we need to understand those also, whether companies have liquidity issues. Very easily you can see where companies don't pay their PF, ESA or employee dues on time or TDS on time, etc. They are all companies which are having whether either it is bad governance or they are probably having liquidity issues. So you should look for clues for liquidity issues to see whether they are having going concern issues. And then there could also be disclosures in financial statements which are not properly done. For example, now this BRSR has come now, on which also we are certifying. So we have to see whether the disclosures are properly done or not. So many information could be missed out or could be wrongly put, etc. So once we have identified the risks, we need to identify which are the significant risks which will cause this material misstatement. So non-routine transactions or unusual transactions, whether areas which are susceptible to fraud, etc. And our role will be to spend more time and focus more energy and resource on areas which are having a higher risk of misstatement. So once you have identified which are the risk areas or which are the fraud prone areas, we need to understand where to focus more. So the whole idea of doing the risk assessment is to spend more time wherever required and plan appropriately for resources and time. So inherent risk you cannot control, but you can at least mitigate. So you need to do appropriate audit procedures and to do that. So normally what happens is you do a control testing first. So you look at 2-3 transactions and fully look at control testing. So if you are satisfied with control testing, your substantive procedures can be minimized to give you comfort. But if the control testing fails, then your substantive testing has to be increased higher, which means you look at transaction level more and more to look at a substantial sample to understand what could be the amount of misstatement that can happen. So, this identifying, you go with first materiality, then you identify the risk areas, then you do some control testing and procedures, and then depending on that you decide on what should be your audit testing procedures basically. So the more and more complex it becomes, you have to design more and more effective procedures to understand what could be the misstatements. And finally, after all this has happened, you need to document every step right from planning and materiality right up to the audit procedures, the risk assessments, etc. What you have done, which are the key areas which you have identified as risk, etc. Document completely, because your peer reviewer, your NFRA, everybody is going to be looking at all the documentation. If you see the NFRA reports, they will be clearly saying the auditor has said that they have identified this as a key risk. However, the planning procedure does not take care of this key risk. Refer para 2.3 in page number 5, etc. That detail they write the report. So they go through every page or every para of documentation to see what is done or not done. So documentation is very critical. So whatever you do and however you conclude, maybe the conclusion is wrong based on our knowledge, but while you conclude, you should document from beginning to end on why you have concluded like that. So at least we are safe to say we have done this. Maybe I have not understood it well enough. This is what I understood, so this is how I concluded. But at least we should not be proved wrong or to be uttering something which is not true. So if you do something, write it. Whatever you do, please write it. So some of the risks that we will normally document in the audits will be the risk at the financial statement level. So what is the risk at the financial statement level is something which will affect the entire financial statement itself. For example, management override of control, or a fraud risk or a going concern risk affects the entire financial statement. So those we have to identify and document. The next is at the assertion level, which will be some area, like for example fixed asset or related party transactions or inventory or something like that, or revenue. So so these also we have to account. And how we have to account is we need to say the risk which you have identified, then what could go wrong in those. So maybe revenue could be overstated because of this, or it could be understated because of this, or there are no proper cutoff procedures, or say it is a service industry, the number of people or headcount is taken wrongly, the rate applied could be wrong. So what could be what could happen wrong and cause the misstatement? Those also you record, and then you also record the audit procedures which you plan to do and which you will also subsequently do with the workings and working papers you should show. that you have done that to satisfy yourself that those numbers are not misstated. So essentially you need to put these 3-4 things for every risk that you identify. And wherever you require a special attention that you have to give, risk areas, so those also you need to document. So audit procedures, for every identified risk you have to document the audit procedure, the nature, timing and extent of procedure. So are you going to look at 10 samples, are you going to look at 25% of the volume of transactions, are you going to look at one and be satisfied, what is it that you are going to do? And where you had professional skepticism, those also you need to specific areas you have to document. And while you do the audit itself, you are at the planning stage, you had a risk assessment, but while you do the audit, probably you will find that it is modified because of something that you have identified during the audit. Those also you need to document, because initial understanding is something, as you do some new things come to light, so you could probably find a new risk or some significant adjustment, etc. So document those also. And then if you are going to use an expert for some areas of estimate, for example the actuarial reports for gratuity or leave encashment, etc., then the rationale for using the expert, the areas of expertise, etc. So normally only I am just giving actuary because that is the common estimate and judgment which is done in all the companies mostly, and how you have evaluated the work of the expert. So you may not know actuarial computation per se, but at least you need to see whether the assumptions which are given to the actuary are correct. Like for example, the number of employees, date of joining, experience, age, the basic salary, etc. All these are verifiable. So all the assumptions which are given to the expert for making the judgments or estimates, those should be recorded correctly. So if it is for a tax matter or some litigative matter that you have gone to an expert and you are taking an opinion based on which say revenue is recognized or something like that, all the facts of the matter should have been clearly been given in writing and presented to the expert before taking their opinion. So here also if you see, we talked about this engagement letter, etc. So similarly, the company should have properly given a letter to the, everything should be in writing. You can't call on a telephone and say I mentioned this to him on a telephone and he gave me an opinion or anything. That cannot be there. So there has to be a proper written document which is given to the expert, on which everything is recorded, and what you are asking for also should be very specifically mentioned, so that there is clarity on the opinion that you get, and based on that what have you done. So all this also should be documented as part of our working papers. And all the key things which you are discussing with the management, those have to be done. Communications with management and those charged with governance. Identified risks, how they are addressed, their perception, what are the significant control deficiencies and misstatements you identified, and what is the response from the management on these which you have identified and reported to them. So just one case of, he has given enough NFRA reports, I am just giving only one case of this. So in this particular case is an NBFC. So for any company, revenue is a risk which has to be mandatorily taken as a assertion risk. You can, unless you have proof of rebuttal, you are not supposed to call it as a non-risk area. So fraud risk in revenue should have been noted for NPA suppression or evergreening, etc. But this was not present in the working papers. And engagement team had not substantiated the securities and collateral, and the team had not done analytical procedures for initial assessment of risk of material misstatement. So this was the report, points, issues pointed out by NFRA. So the work papers do not contain any evaluation on the presumed ROMM due to fraud in revenue recognition. The document broadly contains snapshot of assets and revenue, but has failed, the firm has failed to document the reason for their conclusion in supporting the presumed ROMM due to fraud related to revenue recognition. So regarding analytical procedures also, there were many differences of large rates which were not analyzed. So it is there in the work, this is even worse. So it's there in the working paper, but it's not analyzed. Somebody has not put a comment and closed it to say how they have concluded that there is no risk of material misstatement, despite identifying large variances. Then there are significant rollovers present during the year, but the auditor did not classify the risk of restructuring NPAs despite identifying significant risk of rollover of loans. There had been a woeful lack of clarity and utter confusion had prevailed in the ROMM assessment. In crucial matters, the audit firm had relied completely on the management representation. The audit firm has performed no analytical procedure as risk assessment procedure and have failed to comply with para A13 to 15 of SA 315. The audit firm, after having identified the significant risk of rollover loans, failed to design and implement any response as required under SA 330. The EQCR has also failed miserably in providing an objective evaluation of the significant judgments relating to ROMM made by the engagement team. So, very specifically, they have looked at revenue is a very, very important risk assertion in all the companies. So, unless you have a very clear documentation to say that revenue is not a risk, till such time it is to be treated as a risk area, and you should do the proper audit procedures, etc., to prove that it's not a risk. Or if you treat it as a risk, to see how you are justified to say that there is no material misstatement. So in the absence of documentation, they have gone through pages and pages of working papers. In fact, I have not put the para number, etc. In this particular report, they have said in para 3.5 of page number 5, etc., or something like that, and they have quoted also everything. So documentation. So you may have done the job, but it is very important to write down everything right from the discussion level with your team members, not just with the client, even internally in your office with your team members, to say how you are briefing the team, to make them understand the risk and for them to do the audit. See, we are the signing partner, so first we should have skepticism. And then very important, because our articles, our juniors, or team members may not have that amount of experience, and probably they are not sticking their neck out also. So we need to make them understand all these risks so that they go and do their job properly and come. So if we have not briefed them, there is every possibility that they are not doing it correctly. So one is briefing, which you have to fully document, and after they do the job, continuously checking to see whether they are doing the job, reviewing their work paper. Sometimes they may not treat it as significant and they may just write and give it in the paper. They may not bring it to your attention. So we should have a way of trying to review all work papers, go a little bit over whatever is required. In case they don't bring about such things, then we need to take that extra step to understand whether everything is done correctly and document all these things. So last I think 3-4 days ago, there was an NFRA member who was addressing in the Society of Auditors. So they were saying that including the time spent on audit, etc., will also be monitored by the NFRA. So when you started planning for the audit, depending on the area, have you spent sufficient time? If it's a high risk area, you should have spent more time. If it's a low risk area, probably you could have spent lesser time. Including that, they will be looking at when they are assessing whether the work has been done properly or not. So they were mentioning this also. So some of the challenge and practical consideration is understanding complex entities or complex financial instruments, etc. Sometimes non-obvious risks, so you may not even know how it has happened. Then how do you balancing all the detail with the audit efficiencies? So the best practices that you can try nowadays is to leverage the technology and the data analytics, which is coming to the forefront now. Maintain open communication with the client, which has always been there, and first line of risk assessment for you, and to stay updated on industry trends, business, what happens in the country, outside, etc., to understand what could possibly apply to the business. So some of these we have to do mandatorily. We have about 15-20. We have already crossed our time, is it? Sorry, I didn't know. I actually wanted Sriram just to explain on how they do this risk assessment using some of the tools. So they all have, the big fours have the tools. So of this variance analysis or whatever they may be doing. So few minutes.
Yeah, I'll come.
So because we don't see them, so you can at least tell from your experience, it will be good.
Thanks, Mathangi. So basically, when we speak about the risk assessment, So all the tools, whatever we use currently, etc., actually very much fit under the ambit of this particular standard. So generally the tools, she was telling Excel tools, etc. It can be Excel based, macro based, etc. These tools are generally used from an audit efficiency standpoint. So you have to audit, say, thousands of transactions, etc. You do a tool, maybe instead of 50 hours, someone may spend only 30 hours, 40 hours. That's the common understanding or myth generally the industry or the auditors or auditees have. What really happens is, I think from a sampling risk, whatever I was covering, see, assuming there are hundreds of transactions, you test, say, 10 transactions through a sample, and those 10 transactions actually give favorable results, outcome, etc. Then we say the entire SCOT or the revenue, receivables, etc. is appropriate. What really happens when it comes to these data analytics tools, etc. is you kind of process the whole set of revenue. All the 100 transactions go into the pool. For example, I'll take a simple example, something called three-way correlation. Nothing but any revenue a company generates has to go to a receivable general ledger first. Such receivable has to be corrected at some point of time as cash, assuming no cash sales in the company, assuming every transaction goes through a credit sale model. So the first entry will be receivable to sale, the second entry will be bank to receivable. This is a very normal thing. When you put into a tool, it will say 99% of the transactions have gone that way, except one transaction. Most likely, that will be the anomaly in that whole population, and we can go and attack that separately. So the importance of the tool is, one, having the tool, two, using the tool at an appropriate time. As she was covering, we will do all these things at the time of risk assessment itself, meaning at the time of planning stage, we take the 6 months data. Take the 6 months data from April to maybe September, October time frame, use the tools, etc. to identify what are the transactions that are coming under this ambit. Sometimes you also understand this maker-checker, whatever she was covering. There's something called data churn analysis. Simply, you might see in a company where there are hundreds of employees who actually process transactions, etc. Maybe only one or two approves maybe 500, 600 transactions in on a given day. Most likely, the way he reviews, the way he checks, etc., can be diluted. If someone approves 600 transactions, it can tell you something. So the anomaly there is any transaction that individual employee attacks or approves, etc., can be a challenge, can have some errors, etc. And again, if you take this revenue standard, this 115 perspective, etc., something called portfolio of contracts is allowed. When we go through this kind of a systematic data analytics tool, we will be able to say which are all the portfolio of contracts are together. For example, there can be some 5-6 transactions all passing through the same route. Maybe we can take one sample out of it, and then there are another 10-15 samples which are following the same route of entries. Maybe there is one sample we can take it there, so that the portfolio of contracts is not only just random sampling. You have a application of mind at the time of sample selection itself, so that all variety of contracts are actually covered at the time of planning stage itself, so that we can ask the questions in a better way with the client. What happens is, when you go to a client might say this, generally everything is X works. Once the items go out of the factory, the risk and rewards or the control gets transferred. But what may happen is there can be some selective items where we have to go and deliver. So these tools can really help you, wherein the company would have reversed some revenue, recognized at a later point of time, indicating there's a control transfer happening at a later point of time. So using the data of the company in a meaningful manner at an appropriate time, when I say appropriate time, mostly in the planning stage, to identify the risk, and it will connect to this, basically having the data of the company so that we can ask them. Because any company, if you go and ask, they'll say, yeah, business as usual, nothing has changed based on last year, etc. But when we use the data, we'll have qualitative aspects, we go and question. See, it is not only variance at 5%, 10%. For example, in a company where you expect 10% revenue is going to increase, you can also set expectations. So in that case, even a 9% increase is wrong, even a 11% increase is wrong, because we know it's only 10%. Which can, it all comes back from the expectations, etc., having some market insights, etc. So using the tools to identify the risk and having the risk-based audit is the, I think that's the fulcrum of the data analytics.
So Sriram, you are using market tools or they are developed in-house?
No, mostly, I would say not market. I think all of them are developed in-house. So based on the clients, yeah.
So you told all these procedures, no?
Yeah.
There is an exception reporting is there.
Yeah.
Wherein whatever the transaction doesn't follow the pattern,
yeah,
is coming to the audit time.
Yeah.
So that we can define into the system. Why you have to go all these things?
Which systems are? Audit trail.
Audit trail. So what are the this high risk areas? No, there is a pattern of transactions. It will go beyond that, or in variance it will come into the audit trail. Exception reporting. So it's very easy. Just a click of a button you can get.
So same way. See, the only thing is what you will see there is only the pattern.
No, you have to take all the samples, wasting time. So whatever it doesn't follow the pattern, will go into the audit.
I think most of the ERPs do not allow it. Maybe only yes, sir?
Exception reporting.
No, that's what I'm saying. What you define as exception is very important.
Yes.
What management defines as an exception is a transaction which has to be approved by so and so in 2 days. Not approved in 2 days. It get approved in 3rd days. Can be an exception for them. For us, the exception can be the terms are different. The risk element of the particular transaction.
This is being done by the internal auditors. So wherein they have the exception reporting for all the transaction risk areas. So they will go and define the pattern of transaction. If it doesn't follow the deliveries, then it will come into the auditor.
Yeah.
So we can track that on the weekly basis.
So I think again she covered the understanding the entity in which the entity operates. I think if we can understand what the internal auditors are doing already, we can take some leverage in terms of some of the exceptions reporting is already handled. You may have some additional procedures only from a stat audit perspective. That is also possible. It is not one size fits for all the data analytics tools. There are hundreds of things. If already the client is doing 70 or 80, do the remaining 20, then naturally we get the desired results. That is also the work, sir.
This applies only to the high risk areas, where the revenue suffers.
Got it. Next.
So earlier we used to do this random sampling. That random sampling is not really acceptable nowadays.
Yeah.
And that random sampling, the way we used to do like 20 years ago when we were doing, when I was doing my articleship and all, is not generating a random number or anything. It is actually, me picking some random vouchers here and there, which may not be really random also. So I go and pick up one voucher from every month or one voucher from every week or something like that, or some transaction on every 3rd, 15th and 20th, something like that. That is the way we used to do the random sampling. But now if you see some of these, even for picking the random sample, these softwares, if you want to do only a random sample also, they give you an option. So they actually generate random numbers and they give you that this thing. Yeah. Or they run the Milford's program or something. Some of these tools, you put all the data in and then you say, then it will possibly tell you that these are some probable transactions which are not of routine nature or something. Very difficult to identify by just seeing the ledger dump or anything which we will not know. If I am right, they look at the 7th decimal or something and they identify, and then they will give you that these are the exceptions. So like you are saying, the exceptions are being generated by different methods, and it kind of helps us.
It has become a regular feature now.
Correct.
Due to the volume of transactions. Like EC also, it will expect a trade loss. That also, the company is giving 90 days credit and getting the amount in 120 days, system automatically calculates. Extra 30 days, like the total amount, is showing the risk factor, number of days. So what is the percentage of risk?
Any other questions from anyone on any of the 3 topics which we discussed today?
Yes, sir.
The debtors confirmation and creditors confirmation. What is the base percentage after which materiality comes into the picture? Suppose if we could not get confirmation from 60% of the customers and about 50% of the suppliers before the completion of the audit, whether you should make an observation, comment or qualification.
So getting a confirmation from the debtor, we can only send, we can't force them to give a confirmation. So now even for confirmations there are softwares which are available by which you can actually post it, it goes by mail properly to the right person, etc., and you can document that first you have requested a confirmation from our side, and if you are able to get it, which is very good. So for example, if it is a group company, related party, or a sole supplier or a sole customer, etc., I think it becomes very relevant that you have to get confirmations done by them because they are high risk things. But apart from that, if you are not able to get, then you look for the next alternative indirect confirmation. So you look at collections which are made subsequently after that, before the audit date. So you know that at that date of 31st March, assuming there was a 30 crore receivable, then if he is not going to give a confirmation, if you have collected 15 to 20 crores before the period of audit, it is an indirect confirmation for you to say that those invoices did exist. So, because you can't force somebody to give.
Only thing is that time, it is very short that you find it very difficult to finish the year's audit. Again, you have to go for the next year. It becomes very difficult to get the data.
So, in which case we try and do a top-down approach. At least the top 10 customers, top 15 customers, which will probably contribute. Always that Pareto rule will apply. So, 80-20 only. So, 80% of your volume will come from 20% of the people only. So only those at least we do, so that we know that materially those things have been covered, if not directly, at least indirectly. In case of bank confirmations in NBFCs, if they are not giving, sometimes we send our people to the bank and verify there also, come and document and come, because these bank confirmations are taken more seriously, so we need to do something. So if it is very important, we send our people to the bank, because some banks are very particular. They won't mail you directly. They will say their bank does not permit them sharing information with third persons, etc. So they will not even the confirmation softwares, I think are intimated to the banks and others also, some of the softwares. So I think banks which know all this, and the MNC banks may respond. But still some banks we will still give you in a paper with their bank stationery or something. In which case, maybe we go to the bank and check and come.
Madam, debtors confirmation, you are putting on clause. If they don't reply within 15 days, we treat as confirmed. That is valid? We can do like that?
We won't say it is valid.
It
is kind of trying to protect ourselves.
It won't be actually, because it speaks, this standard called SA 501 speaks about positive confirmation and negative confirmation.
Yeah.
Positive confirmation is someone has to confirm that's the number. We always follow the positive confirmation route.
If he doesn't confirm,
if
because he may not have received it.
Yeah.
No, he has received, but he is habitual. No, he doesn't confirm.
Correct. Many people don't confirm.
So that time you can put 15 days time. You think it's
So generally, what we will do is
we read as confirmed.
In many cases, people don't confirm because, for example, it is tantamounting to accepting that they have to pay it, so they won't confirm.
Correct.
That is why they are not confirmed.
No, madam, they might have not recorded the purchase.
Possible.
Yes, to down to the inventory level. To show the inventory level down.
So the ideal way is first send out the confirmations, send at least 2 reminders.
Reminders.
If they don't confirm based on reminders, then alternate procedures. Generally it should happen. If it doesn't happen, or at least if in case it's a customer with 2-3 years, they don't even confirm, etc. At least once in 3 years they will have to confirm.
To match their inventory turnover, to get bonus and all, they do like that. To keep the level low. They will not take that
Possible.
So any other further questions, clarifications, comments? Thanks a lot. Thank you.
Thank you so much. Thanks.